This evening, we are going to look at standards, which will form 25 marks of the financial reporting paper and 30 marks of the corporate reporting paper if you are a corporate reporting student that you are here. And we also look at final accounts, which will be 20 marks. So basically, we are coming to look at 45 marks what issues this evening. So the final account, it can either be a cash flow or it can be a published account. We all know a published account. The time that you are doing your first degree, they will give you trial balance and they will ask you to prepare a published account or final account for external use or for internal use. But the one that you are going to see in the exam will be for what? External use, not internal use. The internal use is the one that we do the revenue, less sales return inwards, then you come to less cost of sales, then you bring your opening stock, your purchases. Those are for internal use. But for external use, we bring what? Major items. And one of the major items is revenue. One of the major items is revenue. So whenever you have return inwards or sales returns, you have to go and subtract your sales returns or your return inwards from your revenue. So you have to go, if the revenue is 500 and your sales returns or return inwards was 50, you will not bring the revenue and bring less sales returns or less return inwards in the statement of profit or loss. No, what you are going to do is that you are going to show this as a working. So you only bring the net sales. You only bring the net sales. So you are going to do workings or the notes. You show notes. So workings one, then you see revenue as per the trial balance. Then you subtract your return in was 50. Then you now have your net sales of 450. That is a figure that you are going to send to the statement of profit or loss. The account that you are going to prepare is for external use. So you don't have to what? You don't have to make it complicated. So you only show major items and add note to the account. So the notes will give us the workings. The revenue, how was the revenue gotten? How did you get the revenue? The revenue was gotten as a result of we subtracting sales and this from this one. And the final account that you are going to meet in the exam is going to be full of standards. So it's going to be full of the IASs and then the IFRSs. So it's going to be full of standards. The footnote will be full of standards. Okay. The first item that you are going to show will be revenue. What can affect the revenue? The standard that can affect this revenue is the IFRS 15, revenue from contract with customers, where the company can talk about issues with what? A sale or revenue being recognized at a point in time or a point over time. So they can give you an issue relating to that, or where a company is recognizing revenue at a point in time. If they say at a point in time, what is the meaning? The point in time means that you can only recognize revenue when the ownership, the risks associated with the goods has been transferred to the customer. So you can enter into a contract with a customer for 2 years where you are going to say that the ownership or the policy of the company is to recognize revenue at a point in time. It means that you can only recognize revenue when the goods has been finally transferred to the customer. So you can say the customer should make an initial deposit. That initial deposit, since the customer doesn't have control over the goods or he's not in possession of the goods, you still see the asset as your own item. So what you are going to do is that the initial deposit will be treated as what? As a loan, not revenue. So the question can say the company has recognized the revenue and it's part of the revenue. So what do you have to do? The company is still in the possession of the goods. They have control over the goods. Then you have to go and adjust your revenue. So they can bring an issue like that, or they can also sell to a customer right now, and they say that the customer is going to pay in 2 years' time. So the goods has been given to the customer, and the customer is going to pay in 2 years' time, 20 million. In 2 years' time, the meaning is that if the customer should have cash and pay now, the amount that he's going to pay now will not be the same as the 20 million. We are giving him 20 million because he's holding our cash for 2 years. So we are going to consider issue of time value of money. So this particular 20 million include the value of the goods itself and issue with what interest as a result of what time value of money. So how do you go with that one? You take your discount factor, you present value the 20 million, and the present value will be the revenue. So they can also give you an issue called relating to that. There can also be a situation where the goods has been sold at a discount, and some of the goods will be the goods has been sold at a discount, and in addition to this one, the company is going to be rendering a service to the customer over a number of years in addition to the main product. So what you have to do is that you have to separate the revenue relating to the main product and also the services that the after sales services that the company will be providing to the customer. So they can give you so many issues about the revenue, which you have to use to adjust the revenue. And that issue will fall under the revenue from contract with customers. The next item that you are going to bring is the cost of sales. Okay, the cost of sales, what are the standards that can be an adjustment to the cost of sales? You see the cost of sales, we are going to consider revenue. So the IS2, which is inventories, will also have effect on what? On the revenue. We can also have a situation of depreciation, where they will say it is a policy of the company to what? To charge depreciation to what? Cost of sales. There can also be an issue of what? Financial instruments, where the company will what? The initial issue cost. The company is expensing the issue cost. So there is an issue there. There can also be an issue with so many standards. There can also be an issue with so many standards, or there can also be an issue with the IS8 accounting policies, where the company has now changed the accounting policy from FIFO to weighted average. So the inventory will also be what? Will also be impacted. So the next one, then you have, if you subtract cost of sales from revenue, you are going to get profits. You are going to get your gross profits. So it must be automatic. I don't know if you control them. You can program it like this. So the next one is the gross profits. The gross profits, then we can have other income. The other income can be, the other income can be profit on sale of what? Assets. It can also be finance income. It can also be any other form of income. Any other form of income. And another item that you are going to take into consideration is the administrative expenses. You see, if you are preparing the account for internal use, you are going to be having salaries, you are going to be having rents in the normal accounts, like the profit or loss account that we used to do at the SHS level. You see, you have salaries, rent, and those things. No. All those things will now be put together as an administrative expense. So all those expenses that are incurred as a result of you running the business on day-to-day basis will be put together as what? Administrative expense. So expenses like wages and salaries, rent, electricity, water bills, and those kind of things will be put together to have administrative expenses. What are some of the standards that can cause an adjustment to administrative expenses? The first one is the IS 37, which is provisions. So there can be a court case where the company has to make a provision. So there can be an issue like that. There can also be so there can also be an issue with what? Impairment. There can also be an issue with an impairment. There can also be an issue with the 8 again. There can also be an issue with the 8 where there is a fraud. There is a fraud, or there can also be an issue with what? The which standard can come here? Which standard? 37, 36, or which one again? Standards. Any of them can also be there. Then we come to selling and distribution expenses. So the selling and distribution expenses, those advertising, bad debts, discounts allowed, all those things will be put together to have selling administrative expenses. Then if you come to finance costs finance cost is the same as the interest cost. So under the finance cost, we can see bank overdraft interest, anything relating to interest, anything relating to interest. So the bank charges can also be seen as a finance cost. So the finance cost from leases. So you can also have the IFRS 16, which is leases. So since we are present valuing our liability, it means that we have to be unwinding it every year. We have to increase it. We have to be unwinding it. So that particular figure that we are going to charge as an interest will be treated as a finance cost. If you come to IFRS 9, the interest that we'll be paying on the debt, on the instruments, will also be classified as a finance cost. Then you also go to what? Maybe interest on bank overdrafts. That one will also be treated as what? As a finance what? As a finance cost. Then from that one, then you have your tax charge for the year, and the tax will always be the IAS 12. So how do you account for your tax under the provisions of the what? The income tax, which is the IAS 12. Okay, so those are the things that you are going to show. But you see, some of the footnotes are not for you. Some of the footnotes are for the examiner. Just go there, do what you can do, leave the rest, move on to another question. If you read the footnotes, you think for about 2 minutes, you can't do anything about it, move on. Just move on. Leave a space and move on. Okay. If you see final account question, you cannot adjust. It is not possible that you are going to adjust all the items in the trial balance. No, it is not possible that you are going to adjust all the items in the trial balance. Some of them you just bring the figures like that. So they will always ask you to prepare statement of profit or loss and other comprehensive income, statement of changes in equity, or they can ask you to prepare statement of financial position. You can go and put your statement there. Put your statement of profit or loss. You know that revenue will come, cost of sales will come, gross profit, other income, if there's any. Then you count your administrative expenses, selling and distribution costs. You count your finance costs, profit before tax. Then you count your tax charge. You can put the items there before you start working. Statement of financial position too. You can put your heading there. Then non-current assets or assets there, under that one you do your non-current assets, you do your PPE, you do intangibles if there is any. Then you count your current assets. Mostly some of the current assets, you are not going to adjust them. So you can bring the figures like that. Then you count your equity and liabilities. You bring your equity. It can happen that your share capital, nothing is going to happen to it. You bring it like that, retain earnings, maybe you are going to add a profit to it and subtract dividends. So you do workings for the retain earnings. If there's any revaluations of loss, you bring it there. Then you count to your liabilities. So non-current liabilities, you put them there. Then before you even start reading the footnotes, some of the items, you're not going to adjust them. Do your listing, take the figure straight forward, put it there. Then you move on. All right. So without wasting much time, let's pick the final account question 1. Let's do the final account before the standards. Okay. So final account question 1. Yeah, that will be page 10. Okay. Page 10, final account. The draft financial statement of TAFU Limited or something like that. All right. So, Senior Emmanuel, can you see that?
The
Yeah,
draft
please,
financial.
okay. Oh, please, you can continue, right?
The draft financial statement of TAFO Limited for the year ended 30th September 2028 have been prepared by the accounting officer of the company as follows. Draft statement of comprehensive income for the year ended 30th September.
Requirements. Straightforward to requirements. Okay.
Required. Prepare the reverse statement of comprehensive income for the year ended 30th September 2008 and the reverse statement of financial position as at the date using the relevant IFRS.
Okay. So what I've forgotten to say this one. You see, they can give you a trial balance to now prepare your own statement, or they can prepare the statement without taking certain issues into consideration. So they can give you a trial balance to now prepare your financial statement for the first time, or your statement of profit and loss, or statement of financial position for the first time. Or they can prepare the statement, then they will now say that the statement was prepared without taking these issues into consideration. So you have to now prepare a revised statement, taking the additional information into consideration. They can, under the final account, they can also ask you about cash flow. Okay, the cash flow is the same as what you have done at the university level. So that is it. So this is a revised statement. They have prepared a statement for us, and they are now telling us that some of the issues were not taken into consideration before preparing this particular statement given to us. So let's prepare a new statement now, taking the above additional information into consideration. That's what they are saying there. So what we are going to do is that we put our heading there nicely, TAFO Limited, then you come revised what? Revised statement of comprehensive income, revised statement of comprehensive income for the year ended 30 September 2008. So these are the things that you have now. So you can put your currency sign there. They are keeping 3 zeros at the top, isn't it?
Yes.
All right. So you can bring your items first before you even start. You bring your revenue. So you bring your what? Cost of sales. Then you bring your gross profits. Maybe you might do workings for some of them. So okay, some people are saying that people are saying, so gross profits, then we come to administrative expenses. So we might be doing workings for this one. So you can just put them like this, then you read your footnotes. If the revenue, you can decide it the way you have been doing that one for the console. If the workings are not going to be plenty, you can put a figure into bracket and subtract. If it's only one figure that you are going to subtract from it, so you can put it into bracket and subtract the figure. But if you are going to subtract maybe so many figures, or you are going to do so many adjustments, your space might not allow you to subtract all of them. So that is why you have to do workings for that particular item. So maybe cost of sales like this, you are trying to adjust 10 items against the cost of sales. Maybe the space might not be enough for you to subtract it one by one. So you can do workings for that one. So we also have the distribution cost. Then we can decide to bring finance costs. Though finance cost is not there, but finance cost might be somewhere in the footnote. So you can bring the finance cost. If it is not there, you put dash. If it is not there, you can put dash. Okay. So after this one, maybe if you have other income, you can also decide to bring the other income. You can decide to bring the other income, though it is not part of the statement given to us, but decide to bring the other income, if there's no other income, you put dash there. Okay. So it's not, you haven't read the additional information yet. So you are just assuming some of the items there. So if they are not there, you can put dash. Then we come to profit before tax. Profit before tax. Then you come to your tax expense. Okay. Then you now move on to TAFO Limited statement, revised statement of financial position. Revised statement of financial position as at 30 September 2008. Okay. Then let's now put the items there. We have non-current assets. We have non-current assets. Another non-current asset, what are we having?
PP.
Okay. So we have only PPE. Okay. So the PPE, you can leave 2 spaces because you don't know whether there will be other non-current assets in the footnote. So you can leave like two lines. Then you come to the event. You come to current assets. We have inventory, isn't it?
Yes.
Okay. Then we have the trade receivables. We have bank. Am I correct?
Yeah.
Okay. Then we come to equity and liabilities. Equity and liabilities. Okay. So equity and liabilities, we have the stated capital. Stated capital. Just put it. We have your retained earnings. You have your retained earnings. Then you have your 5% preference shares. Okay. The 5% preference shares. The final account, the preference shares are always treated as debt unless it is irredeemable. So you can decide to put it there, no problem, because since they are also classifying it like that, you can also do your own thing. 5%, 5 years, 11% preference shares. So preference shares. You can also come to the current liabilities. You can leave space because you don't have any non-current liabilities in the question. So you can decide to leave some spaces. Then you come to trade and other payables. Trade and other payables. You have your current tax. Then this one. Then you start, after doing this, then you start your footnotes now. Let's start a footnote.
The company, however, has not incorporated all relevant financial information pertaining to the year ended 30th September 2008 in the draft financial statement. The following may be relevant. A. Included in property, plant, and equipment is a production machinery acquired in October 2005 at a cost of 3.25 million. The estimated useful life of the machine is 10 years. In 2006, environmental protection law in the locality that TAFO Limited operates tightened limited the amount of production companies could do, especially at certain times in a day. Accordingly, An impairment review was carried out on 30th September 2006. The fair value less cost to sell and the value in use were estimated at 2.34 million Ghana cedi and 2.47 million respectively. The outcome of the impairment review was accounted for correctly in the financial statement for the year ended 30th September 2006, in accordance with IAS 36, impairment of assets. Subsequent, the impairment review, the industry of TAFO Limited has in recent time experienced a realization in the tight environmental laws imposed in 2006. The amount of production from production machine has increased. Consequently, an impairment review has been carried out by management of TAFO Limited on 30th September 2008 on the production machinery again. The fair value less cost to sell and the value in use estimated at this date are 1.28 million Ghana cedi and 1.08 million Ghana cedi respectively. Property, plant, and equipment are recorded at their carry amount at 30th September 2008, that after depreciation for the year, but before the effect of impairment review undertaken on 30th September 2008.
Do you know-
By one footnote.
Do you know that if after reading this one, you have even used like 2 minutes already? Oh?
Oh man, we'll leave it in
That's why
one
you.
foot.
That's why
footnote.
you do this one. You just scan the footnote and see what they are talking about. Okay, this one they are talking about impairments, and not just impairment. They are talking about reversal of what impairments. So you see that sometimes you'll be there, then you have a software. Then there's an invention of a new software that is going to make your old software useless. And you realize that no, there is the purpose that the new software was developed for, the software is not serving that particular purpose. So you can still use your own effectively now. So it means that a condition that is making your software useless is now what? Positive. So what you have to do is that since the software cannot be used effectively, you have to review the conditions that was there. So what we do now is we do what we call a review of an impairment. The question was specific. They say impairment of assets, not impairment of non-current assets. Okay. It is not only non-current asset that impairs. It's not only non-current asset that impair. Current asset also do impair. Okay. Don't say receivable doesn't impair. Don't say inventory doesn't impair, and don't say cash doesn't impair. But in the exam, they are going to tell you that you should assume that the current assets, the value that they are going to get, the recoverable amount is the same as their net realizable value. So it means that no difference is coming there. But that does not mean that current asset does not impair. Current assets impair, or current assets impairs, not only non-current assets. You have to take note of that before you go and be doing a mistake. All right. Okay, so this one they are talking about something like impairment. There was an impairment conducted and the impairment was reviewed. So what we have to do is that we have to determine the carrying value of the assets before the impairment and after the impairment. What is the position now? Whenever there is a review of impairment loss, this is what you have to do. Assuming the impairment loss was 1,000, but after you have reviewed the impairment or after the condition has now changed, it's now positive, you have reviewed the impairment, you are now realizing that, okay, the gain on the assets now, or the value of the assets now has increased by 2,000. You can see that the value has increased by the loss that the value is now more than the loss that you have previously recognized in relation to the impairment. If this happens, what we do is that we assume that the impairment has not happened at all, because you can see that the gain now is more than the loss. It means that the impairment has not happened at all. So if the impairment has not happened at all, what should have been the carrying value of the assets? And what is the carrying value of the assets now? So we do the combination and take the excess amount to profit or loss. So if the gain, the subsequent gain on the asset is higher than the previous impairment loss, we assume that the impairment has not happened at all. Then we do our normal computation as if we haven't undertake or we haven't carried out impairment tests on the assets. But situation where the impairment loss was what? Was 1,000 and the gain now is 500. You can see that the gain is still less than what? The initial impairment. So what we do is that we reverse all the 500. We reverse all the 500. Okay, we reverse all the 500. But if the gain is more than the loss, then we assume that the impairment has not happened at all. It means that the gain that we are getting now is more than the loss. It means that the asset has not impaired in the first place. But if the loss is higher than the gain that we are recognizing now, we recognize all the gain. So let's take that particular question and see how we can go about it. Yes, Sinia.
What if the subsequent review also result in further loss?
What do you think you are going to do?
Yes, are you going to add the two?
You have recognized the first one already, so you are not going to add again.
Okay.
The first one was done in another year. The second one was done in another year. So that one that happened in the first year, you have taken it to profit or loss already.
Okay. Thank you.
So let's look at this one. Let's look at the impairment that happened first. When was the asset acquired?
October 2005.
So date of acquisition of the assets was October what?
2005.
Okay, 2005. When was the impairment carried out? The first one.
30th September 2006.
Okay, so date of impairment test. So that was 30th September
2006.
2006. How many years after buying the assets?
1 year.
Okay. So at the date of the impairment test, what we need is that we need the recoverable amount of the assets. And the recoverable amount is the higher of the net realizable value or the value in use. So we need the carrying value of the assets, and we also need the recoverable amount of the asset to see whether the asset has impaired or not. So let's look at the carrying value of the assets. The carrying value of the asset is calculated as what? The cost minus what? Accumulated
depreciation.
Okay. In this case, the depreciation will be only 1 year, isn't it? Or only a
Yes,
year.
sir.
So what we are going to do is that what is the cost of the assets?
3.25 million.
3.25 million. So can we 3.25 million? Then minus what? The accumulated depreciation will be 3.25 divided by the useful life. Do you have residual value?
No, sir.
Okay. So divided by the useful life of the assets.
10 years.
That will be 10. Because the depreciation is only 1 year, so it will be the cost minus the accumulated depreciation. Okay. So what are we going to have? We are going to have 3.25 minus what?
0.325.
0.325. If you subtract, what are we getting?
2.925.
925.
Okay. So this is the carrying value, isn't it? Let's look at the recoverable amount. What will be the recoverable amount at this date?
2.47.
2.47.
So we take the higher of the next realizable value or the what? The value in use. All right. What do you mean by value in use?
If they are to continue use the asset, at that time, what will be the value of the asset?
Are you sure? Abanga, are you sure you're not lying to me?
No.
Hey, you're even sure?
No.
I
If they are
think the
supposed to
value
continue using the assets, the cash flow or the amount they'll be receiving or the income they'll be receiving at the end of the useful life of the assets.
discounted to present tense.
Yeah, Abanga, that is it. So you were lying to me. Is if you should continue using the asset, what is the benefit that you are going to get from using the asset? So what you do is that you discount all those benefits to what? To today's term. That is the value in use. What benefits, what value would the asset gives you if you continue using it up to the useful life? That is what we call the value in use. All right.
Okay, thank you.
It's not anything. Sometimes you have to be very hard about what you are saying. Even if you are not saying the right thing, you have to be very what? You have to be very bold. It's very necessary. So what is happening now? Our carrying value is 2.925 and our recoverable amount is 2.47. Would there be an impairment loss?
Yes, sir.
And that will be how much?
0.48.
0. What?
48.
So the loss is 0.48. So the new value of the asset,
Someone should confirm.
the carrying value of the asset will now be what?
0.46.
Sir, 0.46. Sorry.
We are not going to use this. We are not going to use this figure for anything. So don't worry, because they have already recognized that figure already. The question says that the impairment has been recognized already. All right. So what will now be the new value of the assets from October 2006? It will now be the what? The recoverable amount. This will now be the new value.
Amount.
Okay. So are you people approximating the loss? Because I'm getting 0.455.
Yes, 455.
Okay. All right. Because they are keeping 3 zeros, don't approximate. If you take the 0.45, you multiply it by 1,000, that will give you 455. Are you okay? All right. So let's come here. Let's come here. So from the beginning of the next year, which is October 2006 to September 2007, the new value of the asset now will be what? 247, and the useful life will now be what? What will now be the useful life?
9 years.
It will now be 9
9
years.
years.
Okay. If nothing was said about the useful life, it means that the company will still be using the old what? Useful life. So we have done 1 year already, remaining what? Additional 9 years. So when was the review done? When was the review done?
2008.
2008. So how many years that after the first impairment, how many years?
2 years.
It's 2 years, isn't it?
Yeah.
All right.
Yes, sir.
So on 2008, what we need to know now is we need to know our carrying value and also the recoverable amounts. How do we calculate our carrying value? It will be 2.47 minus what? 2.47 divided by 9 times
9
2.
years.
Would that be divided by 9 times 2?
Yes, sir.
Yes.
Yes, sir.
Okay. So that will give us how much?
1.92.
This is the time that you can ask your questions. So okay. It will be 1 point. The depreciation will be what?
That's the carrying value.
Okay, let's get a depreciation figure. So the carrying value will be 1.9.
Depreciation is 0.548.
0.348.
548.
Okay. So it will be 1.92, isn't it? The carrying value will be 1.92. Okay. What do we need to compare the carry value with? We need what? Recoverable what?
Amount.
Recoverable.
Value is the higher of the two.
So what is the recoverable amount given to us?
2.08.
2.08. Okay. You can see that the recoverable amount is now what? Increasing, isn't it? Okay. But if this is the first time that we are undertaking or we are carrying out the impairment test, we don't do anything because this is our first time. So there will not be any impairments. But this is our second time. There was a loss before. So we try to reverse the loss. But if this is your first time, your carrying value is 1.92 and your recoverable amount is 2.08, it means that there is no impairment. If that is the first time that you are undertaking the impairment test on that particular asset. But if you are doing a subsequent impairment test, we don't take the values into consideration again because there was a loss or there was a gain first. So we just carry it the way it should be. Okay. So what would be the gain now? What would be the gain? It will be 2.08. 2.08 minus what? 1.92. What is the gain now?
0.16.
0. What? 16. What was the previous loss?
0.455.
0.455. And the gain now is 0.16. Is the gain more than the previous loss?
No, sir.
So what we do is that we recognize all the gain. We reverse the previous impairment, we reverse all of these parts. So what we do now is the impairment was charged to what? Administrative expenses. The impairment loss was charged to administrative expenses. So what we are going to do now is that we are going to debit our asset, which is PP, with 0.16 million, and we credit our administrative expenses with 0.16 million. It means that the value of the asset is now increasing by 0.16 million, but this has not been taken into consideration. So we come to our second working, which will be administrative what? Expenses. So the administrative expenses. So the first one will be as per statement. As per statement. Don't say as per what? Trial balance. No, we are not giving trial balance. So what is the administrative expenses in the statement of profit or loss?
7354.
549, isn't it? So we come to reversal of what? Impairment loss. Reversal of impairment loss. Would this be addition or subtraction?
Subtraction.
So this will be 160. So we now go to PPE. So our PPE, what is the figure that we have for PPE there? 60424. Then we add 160. We are keeping 3 zeros. So we multiply every figure that we get by what? 1,000. So we are done with the first one. So you can do workings 1 here. You can add workings 1 to this figure. You can also count the administrative expenses and add workings 1 here. Let's come to the footnote 2.
Please, I have a question.
You have a question?
Yes.
Yeah, it's yours, so you can have it.
I have to ask a question.
You want to ask a question?
Yes.
Okay, you can ask.
Please, is it that anytime that we do impairment and we find out that the recoverable amount bigger than the carrying amount, the difference when the recoverable amount is bigger, is it that anytime we find that we question again?
If you can only recognize the gain if that is not the first time that you are carrying out the impairment loss. If that is a subsequent impairment test that you are undertaking, then you can recognize the gain. But the gain that you are going to recognize should not be more than the previously recognized loss. So
Okay.
if this should be the first time you haven't carried out an impairment test on the asset before, and this is the first time, the recoverable amount is what? 2.02, and your carrying value is
Carrying.
1.92. You can see that the carrying value is lower than the recoverable amount, isn't it? So there is no impairment loss. So the asset will still be carried at the 1.92. If the asset is carried under cost model, if the asset is carried under cost model, are you okay? But if the asset is carried under revaluation model, the recoverable amount can still be seen as what? The revalued amount of the assets. Okay. All right. Let's come to the B.
So in this case, you will not add the gain to the assets in the statement of financial position.
If you are which of the model are you using? Cost
Fe-
model or revaluation model?
You are using revaluation model
If you're using a revaluation model, then this
for the
particular
first.
value over here will be seen as the revalued amount. So the gain of 0.6 will be seen as revaluation
Added.
surplus and
Okay.
will be added to the asset and also be sent to what? Revaluation surplus in the other comprehensive income.
Okay, sir.
Let's look at the B. Auntie Beth, are you there?
On
Sorry.
1st September 2008, Tafo Limited purchased materials used for production of 8 products at $0.78 million US dollars under a 90 days credit terms. The exchange rate of $1 is in cedi at the purchase date was 6 cedi, Ghana cedi. At 30th September 2008, the exchange rate of $1 in cedi is estimated to 6.15 Ghana cedi. This purchase is included in cost of sales and trade payables at their transaction value into bracket in cedi terms at 1st September 2008.
Wow.
Which standard is this?
IAS 21.
Exchange rate.
Okay. IAS 21. So you have purchased raw material from an overseas supplier, and how many days do you supposed to pay the money?
90 days.
90 days.
And our reporting period is what? 30th September 2008, isn't it?
Yes.
It means that at the end of the year, still we are owing the people, isn't it? Okay. By the time that you
Yes.
purchase the goods, if you want to recognize this in your books, at the date of the transaction, which is the 1st September, what are the entries that the company is going to pass? What are the entries that the company is going to pass at the date?
You debit purchases and credit payable.
You debit purchases. Are you going to debit the purchases in the foreign currency?
No, in the Ghana cedi.
So you have to convert it, isn't it?
Yes, sir.
So if you are converting it, would that be 0.7 what? 0.78 times what? The exchange rate at the date of the transaction, which is 6 cedis, isn't it?
Yeah.
Okay. So what will be the value?
4.68 cedis.
4.68
cedis.
Okay. Let's count to them. If we should be paying by cash, we credit cash. But this one we are buying on credit. So we credit payables. We credit payables with the same amount, 0.78 times 6. That will be 4.68. Okay. This is at 1st September. But at 30th September, are we done paying these people? Are we done paying them? Or have you paid them at the reporting date? No.
No, please.
So at the reporting day, what you are going to ask yourself is that, what is the balance on these people's account? If I should pay them today, how much am I going to pay them in what? in Ghana cedis. You have to do that. Whatever is going to happen, you are going to pay them the 0.78 US dollars. That is the amount that you are owing them. But the question now is, if you should pay them on 1st September, you are going to pay them what? 0.68 million of Ghana cedis what equivalent. But you haven't paid them on that day. At the reporting day, you are still owing them. The question now is, if you want to pay these people right now, how much are you going to spend in Ghana cedis to settle the 0.78 US dollars that you are owing them? So let's count to subsequent measurements of this particular one. So the subsequent measurement will be the reporting date. This one, inventory, we have already recognized the inventory, so we are not going to have any issue with that. But the question now is, if we want to pay these people at a reporting date, we are going to pay them the 0.78. But what will be the rate for what? $1 to CD. What will be the CD equivalent are we going to use to pay these people now? What will be the CD equivalent?
8.15.
So the CD,
6.15.
so the CD equivalent will be 6.15. That is $1, isn't it?
Yes,
The
sir.
total amount will be 0.78 times what? 6.15. How much are we going to pay them?
4.80.
4.80.
80.
But if we should pay them at 1st September, how much are we paying them?
4.68.
But if you want to pay them right now, how much are you paying them?
4.80.
What is happening?
Every increase.
Yeah, there is an exchange loss there.
Okay, so we have the exchange loss of how much? What will be the exchange loss? What will be
0.12.
0. What?
Oh,
12.
12.
Okay, 0.12. What did the question say? The question said that what this purchase is included in cost of sales and trade payables are their transaction values. So it means that the only value that we have in purchases and these ones are what? 4.68 and 4.68. The new value that has not been taken into consideration. So what we are going to have now is that if you go to payables, we have 4.68. But now the payables is what? 4.80. So what are we going to do? Let's come to payables. What is the payables that we have in the statement of financial position? Would that be 7862?
Yes.
So what do we do now? We add what? 120, isn't it? We add what?
110.
It's supposed to be 120 because the loss is what? 0.12. So if you multiply by 1,000, it's 120. Okay.
Sir.
It was actually 117.
Hello, sir.
Yes, please.
So what if the exchange we had exchange gain, something like that?
What do you think
Maybe
you are going to do?
yes.
What will you do? If you have exchange gain, what will you do?
I think you do the opposite, you subtract.
So why are you asking again?
I need to confirm. Yeah.
Some of the
This is Philip.
confirmations,
I told you today I'll worry you. So
the fact that you are going to worry me doesn't mean that you should be worrying me with things that you know already.
okay, sir. Thank you.
So what we are going to do is that we are having the exchange loss of this. The payables that we have in the statement of financial position is 4.68. It is now 4.80. So we have to go and increase it. That's why we have added a 120. But the loss now, where will it go? Okay, if the question didn't say that the loss should be treated as part of cost of sales or anything, just send it to administrative expenses. Just send it to administrative expenses. So we are coming to exchange rate losses here. Someone can also decide to add it to cost of sales with the assumption that this is relating to inventory. Okay, exchange rate loss. That will give us 120 is a cost. So we add, we move on. Let's look at the C.
See,
Yeah.
the 5 years.
Linus,
Yes, please.
Linus, please, so the 120,
Yes, please.
maybe the 120, can you decide to maybe add it to your inventories?
The inventory is in cost of sales. So
Okay.
in the statement of financial position,
Yes, please.
no, please. It's the payables that is increasing. So you add it to payables.
So it will not affect the inventory.
Inventory is an item. We are not selling the inventory in the foreign currency. So the inventory will not be translated. Inventory is one of those items, one of those non-monetary items that we don't retranslate. Because as soon as you bought the inventory, you are going to what? Translate the value at the reporting date. Then you now start selling the inventory in your local currency. So the inventory will still be at the 4.68 because we are not selling the inventory in foreign currency. The only time that you go about doing something on the inventory is where there's an indication of impairment loss. They will give you the foreign figure. Then you have to look for the recoverable amount of the inventory. But apart from that, we don't retranslate inventory. Because as soon as you bought the inventory, if you buy computer right now, you import a computer, or you import a computer from the US. You import a computer from the US, and the computer you are selling it in Ghana. So the time that you bought a computer, what you are going to do is that you ask yourself, what will be the Ghana city of the computer? So you just translate it 10,000 Ghana cities, and that will be the 10,000 Ghana cities in your books. You're not going to do anything about it again because you're not selling the computers in foreign currency. But if you purchase the computer on credit, it means that you have to what? Settle, or you have to pay your supplier. So if you buy the computers at 100 US dollars, it means that whenever you are going to pay this person, you pay what? 100 US dollars. So if you should pay the person the time that you bought the computer, this will be the CD amount that you are going to pay. But since you didn't pay that day, anytime that you are going to pay, it can happen that the exchange rate will be reducing, or the exchange rate will be what? Will be increasing. That's what we are looking at over here. So we only look at the unsettled transaction, which will always be receivables, loans, or payables. So you don't add it to the inventory. I hope you're okay.
Yes, thank you.
Okay, thank you.
Thank you.
All right. The C. Let's take the C.
The 5 years, 11% preference share presented on the statement of financial position was issued at the beginning of the current year and are recognized as par value of 30 million Ghana cedi. The company incurred cost issued of 0.8% of the par value, and the preference share is redeemable at a premium of 5% over the par value. The effective interest rate of the preference shares is 12%. Issued costs paid is included in administrative expenses.
Which standard is this?
IFRS 9.
Yeah.
IFRS 9.
All right. So under IFRS 9, preference shares are treated as what?
Debt.
They are treated as what? Debt instrument, isn't it?
Yeah.
Yeah. So this we have to account for this particular one as debt instruments. And if you count to debt instruments or a financial liability, they are classified in two ways, isn't it? Debt instrument or
Yes.
financial liability are
Yes.
classified in two ways, and these are they are classified.
Fair true profit and loss. Amortization.
True profit and loss.
Okay. Some people they are also following what people you are saying. Held through profit or loss, held through this and this. Okay. The classification is the same as any other liability. It is current liabilities and non-current liabilities, but we don't call it like that in financial instruments. We have fair value held through profit or loss, fair value not held through what? Profit or loss. So the one held through profit or loss is the current liability. The one not through profit or loss is the non-current liability. And mostly we use the number of years to determine this. So you can see that this is 5 years. So this will be a non-current liability, isn't it?
Yeah.
All right. If it is a non-current liability, we carry it through what we call amortized cost. What do we call amortized cost? The amortized cost is very simple. It's just like a loan. So if you put 5,000 in the bank and the bank says that they are going to be paying you 5% every year, it means that every year you are going to earn interest of 5%, which will be added to your principal. Then the bank will pay you that 5% again. The bank will be giving you the 5% every year. So if you are purchasing 50,000, it means that the 50,000 will be attracting interest of 5% every year. So that interest 5% will be added to your principal. Then you go to the bank and withdraw the what? The 5% again. So the principal will still be there. That is what we call the amortized cost. That is what we call the amortized cost. That is what we call the amortized cost. But what normally happens is that you can also incur a transaction cost. The transaction cost can be a processing fee, or it can be an issuing cost, or a cost that you want to issue. So you have done advertisement for what? For the instrument in a newspaper, you are going to pay. So that particular cost, you are going to incur the cost. It's an expense to you, but you are incurring this particular expense in relation to what? An instrument that is going to be used for what? 5 years. It means that it will be logical, or it will be appropriate if you also what? Spread the transaction cost over 5 years. So the meaning is that you have an instrument of 2,000, you incur a cost of 500. So this instrument will be for 5 years. So this cost will also be assumed to be spread over 5 years, because the cost is relating to what? To the instrument. That is the reason why we capitalize the what? The issue cost, because we assume that the cost will also be used, because the cost is relating to the instrument. So the cost will also be consumed over the useful life of the asset. That's why we capitalize the what? The cost. You can decide not to capitalize this cost if you are not giving effective interest rates. So that sometimes I can give you the nominal rate of this one, 5%. If you are giving a 5%, it means that a 5% is entirely relating to this one. So what you do is that your interest every year will be 5% on 2,000, that will be 100. But in addition to that 100, you will be charging every year 100 cedis as part of the amortization of what? The issue cost. So you are going to be taking 200 as a finance cost to the statement of profit or loss. The 100 is for the interest that you are paying, and the additional 100 is for what? The 500 issue cost that you are also what? Amortizing over the 5 years. But what normally happens is that they will give you effective interest rates. The effective interest rate means that they have taken into consideration the impact of the issue cost on the fair value. So if you are giving effective interest rate, you see that if you are giving the effective interest rate, you will see that if you calculate your finance cost now, the finance cost will be different from what? The coupon. In actual sense, the coupon is the interest relating to the instrument. The coupon that you will always be calculating is the interest relating to what? To the instruments. But the difference in the coupon and in the finance cost is the what? The portion of the issue cost that you should have capitalized. So they can give you an effective interest rate. If you calculate, you get 200. But the actual coupon, actual interest relating to this particular one is 100. The additional 100 is the what? Is the impact of you what? Not what? Capitalizing the 500, but you are subtracting the 500 from the 2,000. So they will give you interest rate, so that if you calculate it, the interest rate will give you the impact of the coupon, which is the interest relating to the instrument itself, and also the figure relating to what? To the amortization of the issue cost. Okay, so I will take it again. If the effective interest rate is not given to you, only nominal rate, don't subtract your issue cost from what? From your fair value. No. Capitalize your issue cost and amortize it over the what? Over the life of the instruments. But when you are giving effective interest rate, the meaning is that they have taken the impact of the issue cost on the fair value. So subtract your fair value or add it, then you now calculate what? The finance cost using the effective interest rate. Okay. Maybe a minor soft question on financial instrument again, but you also have to know this. When the instrument is being issued at a discount, the effective interest will always be higher than the coupon. Okay. So if the instrument is issued at a discount, it means that the value will no longer be 2,000. The value will no longer be 2,000. So we have to take a rate which will have the impact on the what? On the remaining figure. So if the instrument is issued at a discount, the effective interest rate will always be higher than what? The nominal rate. Also, if the instrument is issued at a premium, mostly what you see is at a discount. The instrument can also be issued at a premium. If it is issued at a premium, the opposite of the treatment of the discount is true for what? The premium. So instead of you subtracting, you add, because the premium is an income for a liability. But if it is for an asset, what will happen is that the premium is an income, so the premium will be subtracted from the asset value. Okay, so if the instrument is issued at a premium, what is going to happen is that the effective interest rate will always be lower than what? The coupon rate. All right, because the value will now be higher than the normal. So we have to use a rate which will be lower, because the value is higher, the rate must be lower. The value is lower, the rate must be higher. That is the discount. So let's take this particular one. This is what? Financial instrument. Whenever you are giving preference shares as a footnote, treat it as a what? As a debt instrument. The question will always be about financial instruments. All right, let's look at this. The question says that the company incurred what? Issue cost of how much? What is the issue cost? How much is the issue cost?
0.8%.
And how was the issue cost be treated? How did they treat it?
To administrative expenses.
Must he be there? Must he go there?
No, please.
So what do? We calculate the issue cost and take it from administrative cost, isn't it?
Yes, sir.
So let's calculate the issue cost. What will be the issue cost? The issue cost will be 0.00 times what? What is the value? 13,000.
13 million.
Okay. So what will be the value?
104.
104. Okay. So the 104 will be subtracted from what? Administrative expenses, because it was subtracted. So 104. I hope you're okay with that. Okay. So let's now go to the treatment of what? This particular one. So we are going to have workings 5. Then we have the fair value of the instruments. So we look at the nominal value first. What is the nominal value of the instruments?
13,000.
Okay, 13,000. This instrument is going to be for what? 5 years, isn't it?
Yes, sir.
So the cost must also be spread over 5 years. So what we do is that we take the issue cost. This is an expense, liability. The instrument is a liability. So liability is having a credit balance. But whenever you incur issue cost, what will happen is that you debit your expense and you credit what? Your cash. But this one, we are not expensing it, so we have to go and debit the liability. Debiting the liability means that you are subtracting. So this will be 104. What will now be the new value?
$12,896.
12,800 and what?
96.
So what do? We calculate the finance cost on this value. Okay, what is the finance rate? What is the effective interest rate?
12%.
Okay, so we now have 1.12 times what?
12,896.
Okay, what are we getting?
1548.
1548.
1548. Okay, then what will happen? The company will now receive the coupon. They will pay them the coupon 0.11 times the 13,000. The coupon is the is the actual interest relating to what? To the instruments. So that will give us how much?
1430.
1430.
30.
So this will reduce. So what will now be the liability figure?
One 1304 014
13014.
014.
Okay, so this is supposed to be the figure that we should have for the preference shares. So you go to your statement of financial position. So you go to your statement of financial position, you can do your 13,000 first, then you now add the difference. That will be 104, isn't it? Or it will be 14. Okay.
14.
So you add your 14, or you can decide to bring all of them. You can decide to bring your new figure now without adjusting the old one. Okay. So what will happen? Finance cost will be shown in where? Finance cost will now be shown here, 1548.
Administrative expense
Okay.
and finance.
1548. Okay. Can we take the D?
Linus, please go to the next page, please.
I should go again.
Thank you. This one.
Okay. Let's take the D.
No, go again. Go again, please.
The D.
Yeah.
Tafo Limited has a 1-year contract with one of its institutional customers, which started in June 2008. Tafo Limited, in accordance with the contract, supplies the customer a fixed quantity of each product of 3,000 units. 3,000 units every month at a fixed price of 200 Ghana cedi per unit. Tafo Limited, since June, had been supplying the fixed quantity of each product as per the contract. However, the price of materials, imported, required to manufacture the company's product has increased due to shortage in materials as a result of the adverse impact of the COVID-19 pandemic and the continued depreciation of the Ghana cedis against the US dollars. The current material cost per unit is estimated at 210 Ghana cedi per unit, and the conventional cost is also estimated at 5 cedi per unit. Management is planning of discontinuing the supply of the goods to the customer for the remaining 8 months of the contract. The contract provides a party to give the counterparty at least 2 months' notice in terminating the contract. The penalty for terminating the contract is 8.5% of the sales or purchase value of the remaining unit to be supplied or bought. The only entries made in respect of the contract is revenue, and product costs for the first 4 months of the contract included in the revenue, and the cost of sales figures respectively in the draft account.
That's all. You see, all this thing that you have read, you see, if the workings that we are going to do for this particular thing will even shock you. It's not anything. What standard is that?
IAS 37.
And is under what?
Provisions.
Provisions.
Which part of the provisions is this one?
Onerous contract.
Is what?
Onerous contract.
Thank you. Onerous contracts. So what is onerous contracts?
It's a type of contract where the benefit to be received is below the cost.
The benefit is what?
The cost is more than the benefit.
Oh, thank you. Thank you. Thank you. Thank you for redeeming yourself. Okay. So this is onerous contract. You can see that the selling price of the item is what? The selling price of the items is what?
200.
Okay. But if the company wants to continue supplying for the remaining eight months, what will be the cost that they are going to incur?
210 per unit.
200 and what? $200 and what? What will be the cost? The fish price is 200 Ghana cedis. But if the company wants to continue supplying these goods, what will be the cost they are going to incur? What will be the purchase price? What will be the cost that they are going to incur to what? To produce this particular item?
215.
That will be 215, isn't it? So the
Yeah.
cost will now be 215. What is happening? It means that you are going to what? You are going to spend additional 15 cedis to what? You are going to spend additional 15 cedis to what? To complete this particular what? Contract. All right. The selling price is 200 and you are spending 215. It means that you're going to spend additional cost of 15 cedis to complete the contract. So what you're going to do now is that, okay, the standard says that, will you like to continue the contract or you like to what? Terminate it? So what you are going to do is that, what is the extra cost of you what? Completing the what? The contract or the offer. You are going to receive 200 cedis from the people. So if it is 200 cedis, you receive the 200 cedis from the people and use the 200 cedis to buy the distance. So you're not going to spend any cost there. You're not going to incur any additional cost. But you are receiving 200 and you are spending 215. It means that you are going to spend additional cost of what? 15. So this additional cost, if you are determined to complete the contract, it means that you have to make provision for this particular additional 15 because you are going to spend it. You are going to spend it. There is an obligation for you to spend this particular cost. So you can decide to make provision for this one, or you can decide to make provision for the best one, which is if you want to terminate the contract. The money that you are going to spend is lower than the amount that you are going to, the money that you'll be paying as a penalty is lower than the amount that you are going to spend to what? To complete the contract. So what you do is that you tell the person that you want to terminate the contract where you are going to pay. So you have to make provision for that particular termination cost. So the question now is, what is the cost of completing the contract? Let's look at the cost of completing the contract. This will be calculated on total basis. How many units are we supplying every month?
300.
300.
3,000. 3,000.
3,000. And how many months are left?
8 months.
Okay. So it means that the goods that we are going to supply for the 8 months will be 3,000 times what? 8. That will be the total supply. But this will be supplied at how much? What will be the additional cost that we are going to incur? 15 cedis, isn't it? So let's look at the additional cost. That will give us how much?
360,000.
360,000. Let's come to the other option, termination. If you want to terminate, termination cost. What will be the cost of terminating? What does the question say about the termination?
8.5% of the purchase or sales value.
Or the purchase or the sales value. If it should be you, which value are you going to use? The people are paying you 200 cedis and you are spending 215 to buy. So the penalty, which of these prices are you going to charge your penalty on?
200 cedis.
200 cedis, you're not a fool. So this thing will be charged.
Hello.
You have what?
So I have a question.
Yeah, it's your property, so manage it.
I said I want to ask a question.
Okay.
So the 15, how do you get the 15?
Look, I hope you have the question in front of you.
Yes, I have.
Okay. If the company want to do this, the material price is going to increase due to the shortage and those things, and also the impact of the COVID-19. Can you see those things? Okay.
Yes.
The current material cost per unit is estimated as 210 per unit, and the conversion
Yes.
cost is also estimated at what? 5 cedi per unit.
Right.
The conversion cost is the labor and those ones. Are you okay? Okay.
Yes.
So the total cost that we are going to incur now is 215. That will be the material
Okay.
cost plus the 5. That will be 215, isn't it?
Okay. Yes, it is.
But we are charging the people how much?
210.
200 cedis. No, the fixed price of the contract is 200 cedis.
It's 200. Yes, please.
Okay. So it means that if you want to complete this contract, you are going to spend out from your pocket, from your own pocket, 15 cedis.
Oh, okay.
Are you okay?
Yeah.
So that is the additional cost of what? Completing the contract. So this is how we are going to calculate the termination cost. So the termination will be for the 300, the 3,000 times 8, because we are going to calculate termination over the 8 months. So the termination has to be calculated over the 8 months. So it will be 3,000 times 8 times the selling price, 200 times 0.085. Am I correct? What are we getting?
51,000.
408,000.
408,000. So if you are a business person, which of the options will you go for?
The lower of cost. 360,000.
So you make a provision to cover what? The lower portion. So under onerous contract, we make the provision for the lower of any of the two. So that will be what? 360,000. So the company has to make a provision because they have now agreed to what? To continue supplying this one. So they are going to spend 360,000 to get the material. So they have to start making a provision for that 360,000 now. So what will happen is that the provision will be additional cost to them. This will be treated as an expense added to administrative cost. And this will be treated as what? Other payables, because this particular cost will be incurred over 8 months. It will be for 8 months, not forever, not more than 2 years or 3 years. So this will be treated as what? Payables. So you go to your administrative expenses, you have a provision. You have a provision of 360. Then you count your payables, other payables, you add 360. That is all about this one with these plenty footnotes. It is well. Let's look at the E. Auntie Beth, are you lost? Auntie Beth, are you there?
Okay, so with the E,
Okay.
it says a total dividend of 4.2 million, including preference share dividend, was paid in the year and has been charged against retained earnings. Tax expense represent current tax for the year. The current tax for the year, after taking into consideration the above adjustment, has been re-estimated as 8.1 million. Ignore the effect of any deferred tax.
So what is our new current tax figure?
8.1.
What was the original one?
The original one was 9194.
9194. But it's supposed now to be what? 8.1. So it will be 8,100, isn't it? So
Yes, please.
since you are looking for more ticks, you now look for the difference. So you subtract it from this one to get your 8,100 because you are looking for more ticks. So you can decide to bring the original figure, then you subtract and get the 8,100. In your income, this one, your tax expense will now be 8,100. This will now be the new tax. Okay, let's count to the dividend part. So the total dividend paid is what? 4.2.
Linus,
Yes, please.
please, can you take it away?
Can I do what?
Can you take it over?
I should take which one?
The 8,100.
Where I
The
got
first
it.
the first sentence that you made.
Yeah, I'm saying that the new the new tax now, the new current tax is now 8,100. So this is now the tax expense, not the 91.94. So you can decide to bring the old figure, which is in the statement of financial position. Then you now look for the difference. How much will you subtract from this figure and get the 8,100? Then you can do it and subtract. Or you can decide not to do this one. Then you just bring the 8,100 straightforward. This is now your current tax estimate, which is the same as the amount that you are estimating that you are going to pay to the what? The tax authority. So this is the amount that you are estimating that you are going to pay to the tax authority for this year on your profit that you have made. So this is a potential liability because you are going to pay to the tax authority and you haven't paid yet. So it's a potential liability. So either you bring the old figure, look for the difference and get a new figure, or you just bring the new figure. And if you come to the statement of profit or loss, your tax expense now will be what? 8,100, which you can also do like this. The 9194 minus the figure that will give you this one. Anyhow you want to do it, because you are looking for more text, you can do it like that. What is the total dividend pay for the year?
What? 4.2 million.
Okay, including preference shares, isn't it?
Yes.
Do you know what they are calling a dividend relating to the preference shares? Do you know what they are calling the dividend to the preference shares? Is their coupon?
Yeah.
The 1430. That is this one. So the interest that they are paying to them, the coupon is the dividends. Is the dividend. So 4,200, you subtract 1430 from it. What are we getting? So let's look for the dividend paid to what? The equity shareholders. So let's look at the equity dividends. Let's look at the equity dividends. So the equity dividends will be 4,200 minus 1430. What are we getting?
2770.
2770. Okay. So it means that our sales, nothing has happened to our sales. So let's add administrative expenses and take it to our statement of profit or loss. Any calculator. Chop your head. Is this all? The time we will start to follow me, so go is even going now. I'm getting 73765.
Yes, sir.
Okay. So let's go and bring our figures here. It means that inventory will not be affected, but let's fill this one first. The revenue in the question is what? Nothing is going to happen to the revenue. So we have 245 163. Cost of sales will not be affected. So we have the 110323. Okay, gross profit, nothing is going to happen. Will be 134840. Our administrative expenses, what will be the figure? 765. Our distribution cost, nothing has happened to it. 24516. Okay, let's find our profits before tax now.
Five 011.
35011. So other income will be dash, isn't it? Okay. 35011. So what will be the profit for the year? 26911. Are we okay? So let's fill our inventory. What is the inventory figure? Our inventory figure is what? 87.
736.
Okay. Trade receivables is 19,807. Our cash is what?
29.
29,198. So if we add, what was the total that they have gotten? 57,741. So what will be our assets now? What will be our PPE? 60,424 plus 160. I'm getting 60,584. So let's put the two together. Plus
118 325.
118
325.
325. Okay. Let's now count to our stated capital. Nothing has happened to the stated capital. So we have 52,000. Okay. But something will happen to the retained earnings, isn't it? We have to do workings for the retained earnings. So let's add the trade and other payables. What are we getting? 7862 plus 120 plus 360. I'm getting 8342. So let's do the workings for the retained earnings. Let's do the workings for the retained earnings. So the retained earnings, you can see that the retained earnings figure given to over there is a reporting figure, isn't it? How did they get a reporting figure? They take the opening balance of the retained earnings, add the profit for the year to it, and subtract the what? The dividend. Is that the case?
Yes, sir.
Okay. So what we are going to do now is that the total dividends subtracted from the profit was what? 4,200, isn't it? But the actual figure that should have been subtracted should have been what? 2770. So we now take our retained earnings figure. I will show you two ways of getting this one. So you can start with the reporting figure as per statements. As per statements. So what was the retained earnings figure given to us in the statement of financial position? It is 36,109. Okay. You can see that the total dividend that they have subtracted was 4,200, isn't it? But the dividend that should be subtracted is 27. So what you have subtracted what? The dividend in excess. So what you do is you go and add back the preference shares dividends. Preference shares dividends supposed not to be subtracted from this one. So you go and add your 1430 back to it. What was the profit added? What was the profit added to the retained earnings before getting the 36,109? What was the profit added? The profit was 27 what? 27581. Okay. What is now the actual profit?
26911.
So what is the difference?
617.
So it means that they have added how much in excess?
617.
So the profit that we're supposed to add should have been what? 26911. But we have added what? 27581. We have overstated our profit. So what you do is you go to your retained earnings, then you what?
Subtract.
You subtract. So you do overstatement of profits of the year, overstatement of profit for the year. So that will be how much? That was how much?
670.
670. What are you going to get for the retained earnings?
36869.
So 36 what?
670, not 760.
Is 670.
Yeah, the 670.
Okay. Sorry. So the difference will be what?
36869.
3686 what? 9. That is one way of doing it. Yes, please. I'm recording. Okay. Another way of doing it is that you try to find your opening return earnings first. You try to find your opening return earnings. Then you now add a new profit for the year, subtract your what? Your ordinary dividends. So if you're looking for your opening return earnings, we know that closing return earnings calculated as opening return earnings plus the profit for the year, which was 27 what? Profit for the year was what? 27581, isn't it? And they have subtracted a dividend of 4,200, and they have now gotten 36,109. So we are now looking for the opening return earnings. The opening return earnings will be calculated as the X is equal to 36,109 plus 4,200 minus 27581. What are we going to get for the opening return earnings?
So usually you get the 4,200.
It is in the final footnote. I'm getting 12728. Is that correct?
Yes, sir.
Yes, sir.
Okay. So I cannot prepare my return earnings. I cannot do the workings for the return earnings now. So what I will do is that I have my balance brought down, which was 12728. Then I will now add my profit, my actual profit for the year. Profit for the year was what? 26 what? 911, isn't it? Then I will now subtract my ordinary dividends, which is supposed to be 2770. What are you going to get? You have to get 36869. Someone should confirm. Let's move on.
Yes, sir.
Okay. So let's now count to the return earnings. It will be 36869, isn't it? Okay. Let's put them together. 52,000 plus 36869 plus 13,104 plus 8342 plus 8,100. I'm getting 118325. That is all about this question. The question 2 is May 2019 question, so you can go and check it. All right, I have even solved it on the final account, the link that I sent you. It was these two, it was the first two questions that I've solved. Okay, under the final account in that YouTube video. All right. So this is all about this final account, very simple. And we take some of the standard questions now. The standards, we are going to look at, it is possible that you see financial instruments, you see borrowing costs, you might see revenue, you might also see leases, but it is possible that you see financial instruments. It is possible that you see leases. It is possible that you see revenue. It is possible that you see, which one? Borrowing costs, maybe earnings per share or something. So we take the questions on the leases, financial instruments, earnings per share, borrowing costs. Maybe if you have time, you can look at provisions, IS10, which is the event after reporting dates, and we can also take the effect of changes in exchange rates, maybe accounting policies, and so let's see whether we can solve 8 questions on standards. Let's see whether we can solve 8 questions on standards. Give me prediction. Okay, let's take the Okay, you see that question over there, the question on the property, plant, and equipment. So if you know my YouTube channel, you can go and check maybe PPE, tutorial questions on PPE. I've solved that question there. So you can check that one out. Let's start with the leases. Let's start with the leases question. So leases, we move on to financial instrument. Let's start in that order. Leases, question 2. The Mampontem PLC enter into sell and lease back. Let's look at that one.
Mamponte PLC entered into a sales and leaseback on 1st April 2017. It sold a left with a carry amount of 700,000 Ghana cedi for 400 Ghana cedi, equivalent to fair value, and leased it back over a 5 years period, equivalent to its remaining useful life. The transaction constitutes a sales in accordance with IFRS 15. The lease provided for 5 annual payments in arrears of 90,000 Ghana cedi. The rate of interest implicit in the lease is 5%. The cumulative value of 1 Ghana cedi in 5 years' time is 4.329 Ghana cedi required. What are the amount to be recognized in the financial statement at 31st March 2018 in respect of this transaction?
So the requirements, they're asking you to show this particular transaction in a year time, isn't it?
Yeah.
Okay. This is a sell and lease back. This is supposed to be a corporate reporting one, but they have examined it once in financial reporting. So, Charlie, you don't have to be there and you go. The thing is very simple, but you don't know what to do. So let's take this question. We call something sell and lease back. You have an asset that you are not using, but you need cash. So what you are going to do is that you want to sell it, but you still need that particular asset. So you are out of cash, you need money. So you still need the asset. So what you are going to do is that you will sell the asset for the cash. Then you will still lease it back from the person. But what you have to do is that before you have to do anything, you have to first ask yourself whether the transaction is a sale or is not a sale. If the transaction is not a sale, it means that the company is still in possession of what? The assets. The transaction will not be a sale if the company is still in a possession of what? The assets. We can only say there is a sale when a control associated with the assets, the risk associated with the asset has been passed on to the what? To the buyer. You are saying that you are selling your car to me. I've given you money, but you are still using your car. You are still taking your car out. You are still using your car. You are still the one doing maintenance and everything for the car. It means that ownership has not been transferred to me. You are still the owner of the asset. In that case, the money that I've given to you must be treated as a loan. Okay, but situation where you have given the car to me, you have given the document and everything relating to the car to me, but you have decided to what? Take the car back and be paying me some amount of money. That particular transaction is a sale and must be accounted for in accordance with what? The IFRS 15. So if you are giving a sale and lease back, you first have to identify whether the transaction constitutes a sale or does not constitute a sale. So this one, the question was bold or the question was clear enough to tell you that the transaction is a sale and is in accordance with what? The IFRS 15. The first thing that you have to do is, in any case, the asset must be sold at their fair value. Whatever be the case, the asset must be sold at their fair value. The asset must be sold at their fair value. So it can happen that the fair value of the asset is 4.5, but it has been sold for 4.7. It means that there is what? 0.2. This 0.2 will be treated as what? Additional loan given to the what? To the company by the buyer. Because in every case or in whatever case, the buyer has supposed to pay 4.5 for the what? for the asset. The assets should not be sold below their fair value and they should not be sold above their fair value. So if the asset is being sold above their fair value, the excess amount will be treated as what? Additional loan, or will be treated as a loan facility granted to the what? To the company by the buyer. And that particular loan will be accounted for in accordance with what? Financial instruments. So since the asset will be leased for 5 years, it means that a loan will also be taken 5 years. And that will be what? A financial asset, which is what? Fair value, not through profit or loss. And that will be a long-term what? Liability, and might be accounted for using what? Amortized cost. All right. But if the sale is below their fair value, assuming the fair value is 4.5, the asset has been sold for 4.3, there is a difference of 0.2. This 0.2 will be treated as an advance payment made by what? The company to the buyer who is now the lessor. So that advance payment must be added to the right of use. So if the asset is being sold below the fair value, the difference over there will be treated as an advance payment made by what? The company who is now the lessee to the buyer who is now the lessor. So you have to take note of that. But this one there is no sale above the fair value or below the fair value. If the sale is done, what is the carrying value of the assets? Let's look at the carrying value of the asset first. What is the carrying value of the assets?
300,000.
300,000. What is the fair value?
400,000.
Okay. Okay. And you are going to take the asset back, isn't it? Okay. So it
Yes.
means that the 300,000 of the asset, you are not going to transfer all the 300,000 of the asset to what? To the buyer who is not the lessor. You will be retaining some portion of it. That portion of it will be recognized for the company as the right of use. So how do we calculate the right of use? Is question analysis, question 2, analysis. Question 2, analysis. Okay, so what you have now is you calculate your right of use. The right of use is calculated as the liability, the lease liability, how do they call it? The minimum lease payment. Is it the present value of the minimum lease payment, which is the present value of the liability over the fair value times the carrying value of the assets. So we have to calculate the present value of the liability. The present value of the liability is the same as how you calculate the present value under normal lease. So you can say the question I've given you what? 4.325, isn't it?
Yeah,
Yes.
Yeah, that is the annuity factor for 5 years. If you like, you can try it. So the 4 CD over there is the annuity factor for what? For the 5 years. So let's find the present value of the liability. So the present value of the liability will be the 4.325, which is the annuity factor, multiplied by the renters. The renters are paid in what? In arrears. So that will be 90,000. So our present value will be what? 4.325 times 90,000. I'm getting 389. 389,250. So let's calculate the right of use now. The right of use will be calculated as 389,250 over 400,000 times what? The carrying value, which is 300,000. What are we getting?
Linus, please, the cumulative value of the ones in 5 years time is 4.329.
4.329.
Yeah, not 325.
Okay, so what are we getting? 4.389.
389610.
Okay, so you can tell the examiner that you are using your own figure. Okay. 610, isn't it?
Yeah.
So this will now be 610. So what are we getting now as the right of use?
292.
291.
I'm getting
291.
I'm getting 292
Yeah, I'm getting
207.
291.
208
2922
08.
07 08.
The point
So
5 on it.
second,
Okay.
4 points.
4.329 times 90,000. What are you getting? Okay. So what we do now is out of the 300,000, you are retaining what? 2920 292,208, isn't it? Out of the
Yes.
300,000, you are retaining. Out of the 300,000, you are retaining what? 292,208. So what is the portion of the asset that you are transferring to the buyer? So the ownership that you are transferring, that will be 300,000 minus 292,008, isn't it?
That 292, is it correct? I'm sure it's correct.
Are you sure?
Yes, correct.
It's correct.
3896. It depends on the calculator that you are using and how you can manipulate it. Times 300,000. I'm getting 292,207.5. So we are running it towards the nearest Ghana city. So what would be the difference? 300,000 minus what? 292,207.
7792.
77 what?
92.
So you only calculate profit on what? The profit that you are going to recognize must be in relation to the portion of the carrying value that you have what? Transferred to what? To the buyer. So the profits on the sale will not be the normal profit that you use to calculate as the carrying value less the proceeds, which will be 100,000. No. The profit that you are going to recognize will be in relation to the portion of the carrying value that you have transferred to the what? To the buyer. So the profit will be calculated as the carrying value, the portion transferred, which is the carrying value minus the right of use, divided by the carrying value times the actual profit. The actual profit or the normal profit that you have gotten. Okay. This can also be calculated as the fair value minus the present value of the lease liability divided by the fair value times the normal profit or the actual profit that you have made, which is 100,000. Any of them that you use, you get the same answer. Or you can also pass a double entry for that to get that particular figure. So let's come here. 7792 divided by the 300,000, which is the carrying value, multiplied by the 100,000, which is the 400,000 minus the carrying value. What are we getting? What are we getting as a profits? I'm getting
2597.
Okay. These are the initial recognition. Let's come to subsequent recognition. So the subsequent recognition, you will still account for what? The lease as well, subsequent measurement. You will still account for the lease as a normal lease, where the right of use will be depreciated. So we have the depreciation of the right of use, which will be 292,208 divided by the what? The lease period. What is the lease period of what is the lease period in the question?
5 years.
5 years. So what will be the annual depreciation every year?
Five eight four four two.
58442. Then the lease liability will be amortized. The lease liability will be amortized. So what will happen is that you have your balance at the beginning, which is the opening balance. The lease liability was what? It was 389. So 389,610. Then you calculate your finance cost. Your finance cost. What is the interest rate? If you are doing lease, we use the what? The interest rate implicit in the lease. But if that is not available, we use the borrowing rate of what? The leasee. But this one you are giving 5%. So 0.05 times the what? The value there, 389,610. Then what we do now is you now have your rentals. So the rentals will be paid at the end of the year. So you have your 90,000. Then you subtract, then you now get your balance at the closing. So let's calculate the least, the finance cost. Then times 389,610. I'm getting 19481. So if you go to your statement of profit or loss, you show depreciation. You show depreciation of 58,442, which will be this one. You show a finance cost of 19481. Then you now show your profits on disposal of the assets, which will be the 77, which will be the what? The 2597. All right. So if you like, you can do statement of financial position. Okay, statement of financial position, where you are going to bring your right of use as the difference between this and this. Then you bring the what? Your non-current liability, which is the lease liability. You can decide to split it as current and what? Non-current. Nobody's going to punish you if you don't split it. So if you're not comfortable with the splitting, you can just go with what? The total amount. That is it. Let's look at the second question on the list. Let's look at the second.
Linus,
Yes, please.
please, with the amortization, can you maybe consider a table?
You are doing
Can you
this
use a
for
table?
you are doing this for only 1 year. So what are you going to use a table for?
Oh, okay, okay,
We use a table
okay,
when you are doing for maybe 2 or 3
okay,
years. All right.
okay.
All right.
Oh, okay.
All right.
Okay.
Let's look at
The
the
second question.
yeah.
On 3rd July 2010, Jumasu PLC, Jumasu began to lease a plant under 5 years lease. The economic life of the property has been estimated at 8 years. The lease rentals payable by Jumasu were 5 million Ghana cedi, payable annually on 30th June. At the end of the lease term, Jumasu has an option to purchase the plant for 10 million Ghana cedi, which is expected to be 15% below its prevailing fair value at the exercise date. On 3rd July 2010, Jumasu incurred direct costs of 1.2 million Ghana cedi in concluding this lease, and on 30th June 2011, Jumasu made the first rental payment. At 31st June 2011, the end of the lease purchase, the exercise price has not been revised. An applicable discount rate is 8% required. In line with IFRS 16 leases, prepared extracts of the financial statement of Jumasu for the year ended 30th June 2011.
All right. So this is a normal lease question. And this is for you are doing leasing accounting because Jumasu is the one leasing the assets. So this is leasing accounting. There can also be a situation where they will ask you to do the entries or the computation for the leasehold. So I've also, you can check my YouTube channel on leases. I've done that for both the leasee and the leasehold. Okay. Let's come to this particular one. You see, whenever you are going to estimate the lease liability for the lessee, you have to consider some of the what? Some of the items. The first one is the rental payment that you are going to be making. There can also be a variable what? Payment. There can also be a variable payment. The variable payment might be based on what? Certain conditions. So we have the fixed rental payment. Then you can also have residual values. The lessee will be guaranteeing the lessors and residual values that at the end of this one, this is the value of the asset which we are going to pay you. So we are going to take that one also into consideration. We also take into consideration what we call the option. So the lessor might give an option to what? To the lessee to buy the assets at the end of the what? The contract period. The option is a right which can be exercised or which can be ignored. But you can only consider the what? The option when the lessee is what? Confident. The lessee is confident, or the lessee is sure that they are going to exercise the what? The option. The question will tell you that the lessee is sure, or the lessee is confident, or lessee has the intention to what? Exercise the option. If nothing like that is said, then they are just telling you that the lease is a finance lease. Because if it is a finance lease, there might be an option to purchase the asset. But the option is not a compulsory something that you have to buy. It's something that is optional. You can decide to do it, you can decide not to do it. You can only include the what? The option price or the amount in the computation of the initial lease liability when the lessee is confident, is sure of exercising the what? The option. Let's look at this question. Do you have any info telling you that the lessee is sure of exercising the option?
No, sir.
No, sir. Don't go there and be thinking that since the lessee is going to buy the assets at what? At a price below their fair market value, they are going to exercise the option. Are you in their pockets? The option will always be lower than the what? The market value. The option price will always be lower than the market value because you are giving it to motivate the person or to ginger the person to buy. So you cannot give a price that will be higher than what? The amount that, because the person, I want to use the asset for 5 years. After using the asset, I don't need it again. If you want me to buy, you have to give a price to me that will be what? That will be convenient to me. So the option price will always be below the market value. But you can only include the option when the question says that a lessee is sure, the lessee is confident of what? Exercising the option. But here is the case, nothing is said like that. So the only thing that we are going to use to what? To estimate the what? The initial lease liability is the rent tax. Is the rent tax. So what we are going to do is that we have to estimate the what? We have to find, the question now is, we are giving an asset to the person and the person is paying 5 million every year in arrears. The question now is, if we want to sell the asset to the person today, how much will the person pay for it? That is the present value of the amount that the person will be giving to us. You can see that the rent tax is fixed every year, so we can use annuity. So we can use the annuity factor. So we can look at the initial recognition. The initial recognition, we are going to find the present value of the minimum lease payment. So the lease payment or the lease liability will be the present value of all the what? The payment that the lessee will be doing. So let's now come here. We can use annuity factor for this. We can use annuity factor for this. So what we are going to do is that we have the years, we have our cash flow, we have the discount factor, then we have the present value. The years will be year 1 to 5. Is it 5 years?
Yes, sir.
Okay, year 1 to 5. And the cash flow, how much are they paying every year? It's 5 million, isn't it?
5,000. Okay.
Okay. What is the discount factor? 8%. Okay. Let's find annuity. Annuity for 5 years. 8%. What are we getting? Do you know how to find? Okay.
3.9927.
3.993. Okay. Let me confirm. If you're not a lady, I will not believe that answer. 0.0. So 3.993. Okay. 3.993 times 5. What are we getting?
19963.
I'm getting 19.65. So if you are keeping 3 zeros, then it will be 19965, isn't it? So this is my lease liability, 19.965. I'm using it in millions. So this is my lease liability. So the lease liability, since the control and the risks associated with the asset will be passed to the lessee, it means that the lessee has control over the asset over that particular lease period or that particular 5 years. So they have to recognize the asset in their book, sometimes over form, which is the right of use. They have to recognize the right of use. The right of use. So the asset that you are giving to me, currently the price is what? 19.65. I'm paying 19.65. It means that is the value of the asset. So the right of use, the first figure will be the lease liability. But if the lease liability is if the rentals are paid in advance, then we look at the lease liability, then we add advance payment to it. It means that this is the amount that we are currently owing the company. But out of this, we have already paid some amount. If I'm owing you 20 million now, but I've already paid 5 million, but I'm still owing you 20 million. It means that what you are giving to me worth 25 million. So we add the amount that has already been paid. But if it is in arrears, the right of use, the lease liability that we use will still be 19.65. The asset is just like any other asset. Before I will start using the asset, maybe I have done a repairs or I have done something on the asset to improve the condition of the asset before I will start using it. So any other cost that you are going to incur to bring the asset to a stage that you can start using it, that particular cost must be capitalized. So if you have done maintenance to bring the asset to a situation where you are going to use it, that particular maintenance cost must be must be capitalized. Don't say maintenance costs should not be capitalized. Maintenance costs after you started using the asset should be should be expense, because they are not going to improve upon the capacity, the efficiency, the useful life of the asset. But the cost that you have incurred before you start using the asset, maintenance, it means that you have incurred the cost to bring the asset to a situation or a condition where you can start using the assets. So that particular maintenance cost should be capitalized. So the question will give you a direct cost. The direct cost can be the delivery cost, can be installation cost, or any other cost. So we have a direct cost in the question. So that direct cost will be added to the right of use, which is how much is the direct cost?
1.2.
1.2. So what will be the total value of the right of use? 21. Yes,
21.165.
Okay.
Please, sir.
Yes, please.
What about the 5 million? Won't you add it too?
The payment is done in arrears. The payment is done in arrears. You haven't paid any amount yet.
Okay.
Okay. So you only add the 5 million when the payment is in advance. Okay. You only add the rentals when the payment is in advance. But this one, the payment is in arrears. We haven't paid any amount of money yet. So it means that the value of the asset is the same as the amount that we are owing you. That is all. All right. So let's look at the subsequent measurement. The subsequent measurement, the right of use must be depreciated.
So, Linus.
Yes, please.
Please, so sorry to take you back. So sorry.
I'm sitting at where I'm sitting. So where are you taking me to?
Okay. So you're trying to say that so when you are finding the right of issue asset, that is maybe if the payment is made in arrears, the advance payment will not the rental payment will not be added to right of issue assets.
You haven't paid yet. You haven't paid any amount of money yet. You are going to pay at the end of the year. So you always pay me at the end of the year. So the question now is you pay me 5 million at the end of the year. So the question now is, if you want to pay me now, how much are you going to pay me? All the money that you are going to pay me for the 5 years. If you want to pay me now, how much are you going to pay me? It is what? 19.965. The meaning is that what I'm giving to you that you start paying me in 1 year time is the same as what? The value that you are going to pay me. So if you are going to pay me now, the money that you'll be paying me at the end of every year is supposed to be 19.965. So if you should have money now and you want to buy whatever I'm giving to you, you are going to buy it at what? 19.965. So that is the value of what I'm giving to you now. But the question now is, if you are paying the 5 million at the end of every year, the liability, what we calculate for the liability is the amount that you are yet to pay. That is the lease liability, the amount that you are here to pay. So if the amount that you are here to pay is 20 million, this is the amount that you are currently owing me. But you have already paid me what? 5 million. It means that the total amount that you should have paid me is 25 million, which you have paid 5 million of it, and you are still owing me 20 million. So it means that what I'm giving to you should have been what? 25 million, which you have already given me 5 million, and you are still owing me 20 million. That is how we go about it if the payment is done in advance. But if the payment is done in arrears, the right of use, the initial value, will still be the lease liability. Then you add any direct cost or anything. This particular direct cost over here, the lessor can decide to pay part of it. So if the lessor is paying part of it, you only capitalize the portion that the lessee is paying themselves. So this can happen that the lessor is going to pay 0.2 million out of it. It means that the lessee is going to incur only 1 million. So you only capitalize the 1 million because they are going to pay only 1 million. The lessor will reimburse the 200,000 to them. So the right of use must be what? Depreciated. So we have the 21.165 divided by the 5 years. So the number of years that you use, the years that you are going to use. If the useful life of the asset is more than the lease period, you use the lease period as the years to depreciate the asset. But if the useful life is shorter than the lease period, then we use the useful life and ignore the lease period, which will always not be the case. So let's look at the depreciation for the right of use.
4.233.
4.23. Let's come to the lease liability. The lease liability will be amortized.
It's 331.
4.33. Okay. The lease liability. 233. Let's make it 2.3. 4.23. Okay. The lease liability will be amortized. We start with the opening balance. Then the opening balance is 19.965. You charge your finance cost, which will be 0.08 times 19.965. Then the figure that you now pay the rentals. The rentals will be paid at the end of the year, 5 million. Then that is all. You get your closing balance. You send your depreciation and finance cost to profit or loss. Then you send your carrying value of the right of use to statement of financial position as an asset, and also the lease liability as a non-current liability. Before I'll move on to financial instruments, the company can decide to subsequently measure the right of use using a cost model or revaluation model, because that is an asset. So it can be under cost model or revaluation model. You have to take note of that. So if it is under revaluation model, you account for it in accordance with IAS 16, property, plant, and equipment. But mostly the question that you'll be seeing will be under cost model. But the right of use can actually be carried at revaluation model, where at the end of every year, you revalue the right of use. That is very important. Let's come to financial instruments. let's take the question 1 and 2. Financial instruments, question 1 and 2. Financial instrument, who is reading for us? Or people, you want to take some minute break?
No.
Okay.
Please, can you go back to your screen? I want to check something.
You said, can you? Are you saying, can you? Abanga, are you asking, can you?
Yes.
No, please, I can't go.
Okay, I'll beg.
Say, go back to the screen. You see, you people, you Africans, you feel like you are respecting. In actual sense, it's not respect. Go back to your screen. It's not disrespect. But people, you seem to be too moral, but ethically you are not. Go back to your screen. There's nothing wrong with that. But the African man will see that it's a disrespect. You see, instead of people to be fighting over money, you are fighting over certain things.
Man, you're not an African
Okay,
man.
thank you. It's
Financial
okay.
instruments.
Okay.
Another question 1 and 2.
Yes, financial instruments.
On first question 1. On 1st October 2013, Bolliger Limited issued 10 million Ghana cedi 6% convertible loan stock on the following terms. The issue price was at par. The loan stock is convertible into the company's equity share at the option of the shareholders for 4 years after the date of its issue, 30th September 2017. On the basis of 20 shares for each 100 Ghana cedi of a loan stock. Alternately, it will be redeemed at par. Lagos Services had advised that if Bolliger Limited has issued similar loan stock without the conversion right, then it will have had to pay an interest, like a coupon rate of 10% on the loan stock. This is because the terms of conversion to equity shares are favorable. Lagos Services further advised that because it's almost certain that the loan stockholders will exercise their right to convert to equity shares, the loan stock has the substance of equity and can be included as such on the statement of financial position. This has the added advantage of improving or reducing the company gearing, into bracket debt over equity, in the comparison to what would be the case with the issue of right loan stock required. In relation to the 6% convertible loan stock, calculate the finance cost to be shown in the statement of profit or loss and the extract from the statement of financial position for the year to 30th September 2014 and comment on Lagos Service advice.
So which one is this is a hybrid instrument, isn't it? This is a hybrid instrument. Okay. So what do we do? The hybrid instrument has characteristics of both debt and what? Equity. So what we do now is that we ask ourselves what portion of this particular instrument is for debt and what portion of this particular instrument is for what? Equity. So we always look for the debt one. The debt one will always be the cash component. The debt component of this particular instrument will always be the cash component. So the debt will be the what? The cash that we are paying. So for you to find a debt component, we present value all the cash payment that will be made under what? This particular transaction. So you see that the cash payment that will be made every year, or the cash payment that will be made will be what? The coupon. They are going to be paying the coupon to what? To the debt holders. And at the end of the year, they are also going to what? To receive their what? Their nominal value, because the debt will be redeemed at par. So they are going to be receiving coupon every year. And at the end of the period or the redemption period, they are going to receive, or the company will pay their money back to them. The company is going to buy back the what? The instruments. So the cash that they will be receiving will be the coupon plus the redemption value. Those are the what? The cash that they are going to receive under the debts. So what do? We present value all the cash payment that will be made under this. In other words, the meaning is that, okay, if you are giving me 10 million today, it means that any amount that I'm going to pay to you must be in relation to what? To the 10 million. So any amount that I'm going to pay to you in the future, if I should find their today's value, they must be the same as the money that you are giving to me. If they are not the same, it means that there's a portion of it which is not for debt. All right. So we always find a debt component. So the debt component, we do the splitting between debt and what? Equity. The debt component will always be the present value of the cash. Okay, so what we do now is we have the years, we have the discount factor, which the discount factor will always be what? The rate of a similar bond without what? A conversion right. So if you are going to do it the first time, we assume that the instrument will not be converted. The instrument will be converted after the period. So after the 3 or the 4 years, that the instrument holders will not decide whether they should what? Convert it to equity or not. They can only convert it to equity when the terms of conversion are what? Favorable to them. So what is the rate without what? Conversion right?
10%.
So that will be discount factor will be 10%. Then we have the cash flow. Then we have the present value. So the years will be what? The instrument will last for how many years?
4 years.
Is it 4 years?
Yes, 4 years.
Okay. Let me see whether I can also see the 4 years. Where are you seeing the 4 years?
The loan stock is convertible into the company's equity.
4 years after the date of issue. So sometimes they don't give the 4 years, they can give you the date of issue and the date of redemption. So you find the difference yourself. So year 1 to 4, the company will be receiving what? The coupon, which is 6% of the what? The nominal value. Is that correct?
Yes, sir.
That will give us what? 6 million. Would that be what? 0.6. Okay, 0.6 million. Okay, this supposed to be, this is a discount factor. Okay, so the 0.6 supposed to be the cash. So it means that every year they will be receiving a coupon of 0.6 on the nominal value. So what will be the discount factor for 4 years? What will be the annuity factor for 4 years?
3.17.
3.17. At the end of the 4 year, what will happen?
They will receive the par value also.
Okay. The instrument will be redeemed at 10
It's
million.
supposed to be there.
So what will be
The 10 million is supposed to be there. It's supposed to be under cash flow.
It's supposed to be under. You see, mostly I use the cash flow first, so it's confusing me, but not you people. So what will be the discount factor in the 4th year?
0.68.
0.68. Okay.
Yep.
5.4. Okay, 0.683. Okay, so this will give us 6.83, isn't it?
Yes.
So let's find 3.17 multiplied by 0.6. 1.902. Is that correct?
Yes.
Okay, what are we getting? If you add it to
8.7.
732.
8.73. Let's make it 8.73. So this is a debt. But what is the total value of the instrument that we are receiving? How much are we receiving?
10 million.
So it means that there's a portion of it that is for equity. So what will be the equity component? So equity component will be this one. So the debt component is what? 8.73. 8.73. The debt component is 8.73. There can also be a situation where they will give you issue cost. But the issue cost, what we do is that the issue cost will be for equity and debt. So if there's an issue cost, what you do is you first split it. After splitting it, then you now use their what? Their proportion or their value to now split the what? The issue cost. Assuming the issue cost is 1 million. So we have issue cost of 1 million. The issue cost will now be what? Shared like this. Debt will be having 8.73 divided by 10 times the 1. Equity will now be having 1.27 divided by 10 times 1. That's how you go about it. That's how you are going to share the issue cost. But there's no issue cost. So what will happen is that the debt component will now be carried at what? Amortized cost.
Yeah,
So
if there's a discount, how will you do?
If there's a discount, you subtract the discount from the value. The value that you are going to use over here, the 10 that you are going to use over here. You subtract the discount from this one.
Thank you.
All right. Okay. So the discount that you can net the discount before you calculate your equity and debt component. But for the issue cost, you have to share the issue cost to them. All right. So the subsequent measurements, our debt component will be carried through amortized cost. So what we have over here is that we have our balance as starts, which will be 8.73. Then you calculate your finance cost. The finance cost will be calculated using the what? The rate that you use to discount the cash flow. So 8.73. That will give us 0.873. Then you now calculate your coupon, which will be 0.6. Okay. So you subtract, you get your balance, you send it to your finance cost will go to profit or loss. Your equity will go to other components of equity and the equity. Then the debt will go to what? Non-current liability as financial liability. Let's take the second question. Let's talk about advice. Okay. The people are saying that the instrument contain what? A potential value of what? Equity. So it's going to improve upon the what? The debt to equity ratio. You see, this figure will be added to the equity of the company. So you can see that instead of us having a debt of 10 million, 1.27 of the debt will be added to equity. So there will not be a much effect on what? On the instruments. There will not be a much effect on the instruments. And if the instrument is being converted into equity at the end of the 4 years, it's also going to improve upon the capital structure of the company. But for the meantime, the 8.73 will now be classified as debt. But instead of them having all the 10 million as debt, it is now 8.73 for debt and 1.27 for equity. So that effect of the 1.27 will be having on our capital structure or our gearing ratio, if it should be a debt instrument, will now be what? Will now be neutralized. So they are saying that as this compared to what? Straight what? Debt what? Instruments. The straight debt instrument is where there is no conversion, where it is preference shares, or it is what? Debentures. Straight. There is no conversion attached to it. So if it should be a straight debt instrument, the debt will be what? 10 million, no equity component. No equity component. All right. Let's come to the question 2. Let's do with that. We move on to the revenue. Let's do with the revenue. Then we see whether we can deal with borrowing costs or borrowing costs and maybe earnings per share. You can try the effect of changes in this one. The question on the accounting policies, changes in accounting policy, I have solved that question within in one of my lectures. That is the if you see it, you see IS 8 and IS 10. So the question under the effect after reporting date, we have solved that one too on that particular one. So if you have time, you can cross check and see. So let's take the second question under the financial instrument. Then we come to the question under revenue debt.
On 1st January 2017, Tamale Invested Group, TIG, issued 10% 200 million Ghana cedi bonds on the domestic debt market. The bonds were sold at a premium of 20% of their nominal value. Transaction costs of 10 million Ghana cedi were incurred. The coupon is payable annually in arrears. The bonds must be redeemed on 1st January 2020 after 3 years at a discount of 1.33 million Ghana cedi approximately. The effective rate of interest is 5% per annum. On 1st March 2017, TIG applied the bonds proceeds to subscribe for 12% equity interest in Abiola Technologies into bracket 80 for 128 million Ghana cedi, including associated transaction costs of 5 million Ghana cedi. 2 months after the subscription, AT paid dividends worth 25 million Ghana cedi to its equity shareholders. All these dividends were paid out of AT retained earnings balance at 31st December 2016. TIG made an irreversible decision to account for the investment at fair value through other comprehensive income. Market capitalization of AT as at 31st December 2017 was 2,500 million Ghana cedi. Required in line with IFRS 9 financial instruments. Explain how the above will be accounted for in the financial statement of TIG for the year ended 31st December 2017.
That's all.
Yeah.
Okay, that is nice. Okay, that is nice. All right. So let me see the question again. All right. All right. So they are saying that what the first journalists and this Tamale investors issued what 10% 20 million bonds on the domestic debt market. The bonds were sold at a premium of what 20% of their nominal value. Transaction costs of 10 million were incurred. The coupon is payable annually in arrears. The bond must be redeemed on this one after 3 years at a discount of what 1.33 million approximately. The effective interest rate of what the effective rate of interest is 5% per annum. Okay, on March 2017, these people are. So what are you can see that the company, there are 2 issues here, isn't it?
Yes, sir.
Okay. One is the company having financial liability and also what a financial asset, isn't it?
Yes.
Okay. So what are they saying? They say we should account for this particular one. We should account for this particular issues on what 31 December 2017, isn't it?
Yeah.
Yes.
Okay. So you can see that the financial liability will be for a full year, isn't it? So let's take
Then
the financial liability first. So the financial liability, you have to determine the fair value of the financial liability. So the fair value, we are going to determine the fair value as, then we look at the nominal value. What is the nominal value of the instruments?
200 million.
200 million. Okay. This was issued at a premium of what?
20%.
20%.
So what will be the premium? 0.2 times 200 million. How much is that? $40. So what would the premium be accounted? Addition or subtraction?
Addition.
Premium will be addition because premium is an income. Okay.
Mhm.
Then we have transaction cost. Transaction cost will be what? This is a liability. Transaction cost will be subtracted. And that is how much?
10 million.
Okay. So what will now be the fair value?
I said there's a discount.
The discount is something that will be enjoyed after redemption. So that is after 3 years, not now. Read that part again.
Yes, sir.
So the discount is not something that they are giving now. No. Are you okay?
Yes, sir.
All right. So let's now. So this is a fair value now. So on this fair value, we can calculate our finance cost. So our finance cost will be what? The effective interest rate is 5% times the 230. How much are we getting?
11.5.
11.5. And our coupon will be how much?
20 million.
So that will be 0.1 times the nominal value. That will give us what? 20. But you can see that the actual interest on the loan should have been how much? The actual interest on the loan should have been how much? The actual interest on the loan should have been how much?
The 20 million.
That would have been 20 million, isn't it? All right. But the cost the amount that you are charging now is what? It's 11.5, isn't it?
Yes, sir.
Okay, so this 11.5, you can see that the premium is an income which will be amortized over 3 years. So the amortization of the premium, which is an income, is net against the cost. And also the transaction cost, which is a cost, which will also be amortized over 3 years, is also added. So that is why we are having this figure as a finance cost. So it means that they have already, the premium, which should have been an income that should be amortized over 3 years, the amortization has been net against the what? The finance cost, the actual finance cost of 20 million. And the transaction cost has also been added before the premium has been what? Subtracted. That is why we are having the finance cost of this. So this finance cost, the 20 million is actual finance cost or actual interest relating to what? To the loan. That is reduced to 11.5 as a result of the premium, which is an income. All right. So the difference over here will go to your statement of profit or loss, statement of financial position as financial liability, but this will go to profit or loss. Okay, let's look at the other part.
But sir, can you calculate without adding the fee?
You said?
Can you calculate the fair value without adding the fee?
No, since you are giving effective interest rates, it means that the premium and those things has been net before they have given you the effective interest. So you have to do it and use the effective interest. But if the question has not given you effective interest, then you calculate your interest separately, you amortize your transaction cost separately, then you amortize your premiums too separately.
So sir, what is in the question? There's discount and then when what? There's a discount.
And the discount they have if they have given you effective interest rate, then the discount must also be net against the what? The nominal value. But if the effective interest rate is not given to you, then you calculate your actual interest rate on that one. Then you also amortize the discount over the what? Over the period of the what? The instruments.
Yes.
Are we okay?
Yes.
All right. Let's come to the next one. On 1st March 2017, TIG applied the bond proceeds to subscribe for 12% equity interest in what? In Abiola Technologies for 128 million. So what is the fair value? What is the value of this one? It's 128, isn't it?
Yes, sir.
Okay. So 128, including associated what? Transaction cost of what? So it means that the transaction cost is still in the 128 million, isn't it?
Yes.
Okay, but we have to know how they are classifying these particular instruments. So if we know how they are classifying the instrument, because this is what? Financial assets through what? Equity investments, which will be classified as profit or loss or other comprehensive income. So we have to know how the instrument is being classified. Okay. 2 months after this subscription, AT paid dividends worth what? 25 million to its equity shareholders. All these dividends were paid out of what? AT's retained earnings at 31 December 2016. TIJ made an irreversible decision to account for the investment at fair value through other what? Comprehensive what? Income. Through other comprehensive income. Market capitalization of AT as at 31 December 2017 was what? 25 million. Very simple. Let's now calculate. So this is through other comprehensive income. It means that the transaction cost must be what?
Capitalized.
Capitalized. So we subtract. Okay, this is asset, so we add, isn't it? Okay, it is already part already, so we don't have to do anything. But if you like, you can make this one 1, 2, 3. Then you now come and add the what? The transaction cost. So that all of them will be 128. Are you okay? All right. Let's now come here.
Please do it 128 straight.
Is it?
Please do it 128 straight so that it will do.
You don't like ticks?
Oh, okay.
2 months after this subscription, AT paid dividends worth for 25 million to its equity shareholders. So the 25 million was the total dividend paid to the equity shareholders, isn't it? Okay. What is our percentage of the shares?
12%.
Is 12%. So we have to find a dividend. This is how we are going to account for this particular instrument. So the subsequent measurement will be the fair value. The fair value will be 128 million. Then we add finance income. Okay, the dividend that you'll be receiving will be the finance income. So this one, sometimes they can give you a rate attached to this one. They can see that they have purchased this, and this is the rate. But this one, they have just given us a portion of the shares that we have purchased. So the dividend given to us is what? 25 million. Given to all the equity shareholders is 25 million. But we are having only 12% of this. So we are going to have 0.12 times 25 million. We don't prorata dividends. We don't prorata what? Dividends. So don't say that this will be 9/12. No. We don't prorata dividends. Okay. So what will be our share of the dividends?
3 million.
So that will be 3 million. And the coupon will still be the same as the 3 million. Okay, so the coupon will still be the same as the 3 million. So the income is 3 million. They will still pay us what? 3 million. So our value will still be 128. By the end of the year, what do we have to do? We have to find the fair value of this particular instrument, isn't it? We have to find the fair value of this particular instrument and compare with the current value that we have. How do we? Someone wanted to call me. Okay, so he's not here.
Yes, sir, please, how did we get the coupon to be 3 million?
The coupon is the same as the finance income. The dividend, they will pay you the dividend in cash. So the dividend is an income which you are still going to receive in cash. So mostly the dividend is the same as the coupon. Are you okay?
Okay.
All right. So we have to find a fair value at the date of reporting and know whether we are having a fair value gain or not. How do we find that? They have given us what? They have given us the market capitalization rate of what? This one. The market capitalization rate is the market value of the company. The market value of their equity shares now is what? 25 what? 2,500 million. So if it is 2,500 million, what will be our portion of it? It will be 12% multiplied by the 2,500. How much are we getting?
300.
300, isn't it? So the fair value of the instrument now is 300. What is happening? We have 128. The fair value now is what? 300. What is happening there? There is a fair value gain
Fair value gain
of what?
172.
172. So this will be sent to other comprehensive income. And the dividend will be sent to what? The dividend will be sent to profit or loss as a finance income. So in the statement of financial position, that the financial assets will be shown as what? 300 million, which is the fair value. That's all. Let's take the revenue question.
Linus.
Yes, please.
Please go back to the market capitalization. Explain again. Thank you.
I close 10:30. I got close 10:30. The only two standards are so. I know to solve it. I be as of 2 people under. If I answer all the 8, it would be like 12. Yeah, I'll go with them. I will solve revenue then borrowing because that be all.
The ones you not teach, so revenue then borrow.
I will solve. If you don't go with the one I will solve now. Should I hope we can move forward.
Yes.
Okay, so let's take the question on the revenue.
Bridgenorth has undertaken $5 million contract to repair a railway tunnel. The contract was signed on 1st April 2008, and the work is expected to take 2 years. This is a contract where performance obligations are certified over time, and progress in certifying performance obligation is to be measured according to % of costs incurred to date. Bridgenorth has an enforceable right to payment for performance completed to date. Required compute the revenue, cost of sales, and hence profit Bridgenorth has to recognize in the statement of comprehensive income for the years ended 31st December 2008 and 2009. How much contract asset into bracket liability is to be recognized in the statement of financial position as at 31st December 2008 and 31st December 2009.
All right, thank you very much. We are very grateful. So This is IFRS 15, which is construction contracts. Okay. Under IFRS 15, whenever you have construction contracts, we have two ways of recognizing the revenue. I've said that already. Revenue can be recognized at a point in time. At a point in time means that you recognize revenue when control ownership has been passed to what? To the buyer. So if the asset will be completed over 2 years, if the asset will be completed over 2 years, okay, if the asset will be completed over 2 years and you are recognizing revenue at a point in time, it means that the only time that you can recognize revenue is when the asset has been handed over or has been passed to the buyer. So any amount that the person is going to be paying or the initial deposit should be treated as a loan. If it is a construction asset, then you are going to treat the initial amount as a loan, and you assume that that is a loan that you are taking to what? To finance the construction of the asset. So the interest on the loan will be capitalized as a borrowing cost because you are constructing the asset for the person, but you are recognizing the revenue at a point in time. So the amount that the person is going to give to you now will be taken as a loan because you are still in possession and in control of the assets. But this is a qualifying asset. So the loan, the amount that the person has paid to you as an initial amount will be seen as what? A loan taken to finance the construction of that particular asset. So that will be the interest that you'll be paying will be what? Will be treated as a borrowing cost. You have to take note of that. All right. We can also have a situation where the revenue will be recognized at a point over time. At a point over time is a situation where if you are constructing a story building, the person can decide to move in if you complete some part of it. They can decide to move in if you complete the first floor or the ground floor. I don't know how they call it. So since the work is in progress, the person can start making use of what? The portion that have been completed. So you can complete first part of the work and the person can decide to move in. It means that control of that particular site has been passed to the person. So you can recognize revenue relating to the portion that you have completed. That is the point, revenue recognized at a point over time. So as soon as completion, you have completed the work, the revenue relating to the work that you have completed should be recognized. And we use two methods of doing this. The first method is what we call the input method. And we also have what we call the output method. Input method. The input method, what we do is that we find a percentage of the cost incurred. We find a percentage of the cost incurred of the total cost to complete the contract. So the cost incurred up to date over the total cost of the contracts multiplied by 100. That will give you the percentage of of the revenue that you are going to recognize. But if you come to the output one, we measure it up to the work certified. So what was the work certified? What was the work done and satisfied over the revenue contract? That is output. We do it on output level. So the output level, what was the work done and what will be the actual value of the work? So the work done, which is the work satisfied, over the revenue itself times what? Times 100. That will give you the portion of the profits or the revenue that you are going to recognize in profit or loss, and portion of the cost that you are going to recognize in what? Cost of sales. But if you come to input level, we look at the input that will be going into the contract. So the cost incurred up to date over the total cost of the contract times 100. That will be the portion of the cost that will be taken to cost of sales, and that portion of this will be taken to what? To revenue. So this one, they are saying that they are using input method. They are using what? Input method. So what we do now is that we do it for 2008 and 2009. What is the contract value? What is the contract value? What is the contract value?
5 million.
So the contract value is 5 million. Okay. Contract value is 5 million. What is the cost to date? Cost to date is what?
1,800,000.
Cost to date is 1,800,000. Okay. What is the cost, estimated cost to completion?
2,200,000.
Estimated cost to completion is what? 2,200,000, isn't it?
Yes.
Okay. The issue now is let's find the input percentage. So the input percentage will be the cost incurred up to date. I will show you how you can go about. So you have so many ways of going about this one. But the question asks us to what? Recognize revenue and also cost of sales and also the profits. So the input method will be the 1,800,000, which will be 18. Would that be 18 divided by what? 22 times 100. I've taken all the 5 zeros out. No, that will not be this one. It will be 18. What will be the total cost of the contract?
5 million. So
No, that is the contract value. The cost. That is the revenue. That is the sales value. The cost. We have incurred a cost of 1.8 million, and we are expecting to incur a cost of what? 2.2 million. So what is the total cost of the what?
4 million.
That will be 4 million. So we have 1.8 divided by 40. So that will give us the input method is the cost up to date over the total cost to complete the contract. So 18 over 40 times 100. What are you getting?
45%.
So it means that the 45%, our revenue that we are going to recognize will be 45% of the contract value. So 0.45 times 5 million. What are you going to get? What are we getting?
2.25.
Okay, I'm getting 2.25. So 2.25. That is the revenue. You only recognize 45% of the revenue because you have completed 45% of the work. So the revenue that you are going to recognize will be 45% of what? The revenue. But what will be the cost that you are going to recognize? The cost will still be the same as the cost to date. Or you can decide to find 45% of the total cost. The total cost that you have to spend on the contract is 4 million. And you have completed 45% of the work. So what will be the cost relating to that? That will be the same as 45 times the 4 million, which will always give you the cost to date. So in your cost of sales, you are going to be having what? 1.8 million. What will now be your revenue? What will now be your profit rather? The profit will be what?
2.5.
Profit will be what?
750,000.
The profit 225 minus 180. I'm getting 45.
Oh, sorry. Yeah, 45.
Okay. That will be 45,000 or 450.
Yes. 450,000.
450.
Okay. So this is the profit. Okay. You can also calculate the profit like this. Okay. Let's look at the profit that we are going to get from the contract itself. We know that our contract value is what? 5 million, isn't it?
Mm-hmm.
The cost that we are going to incur in year 1 is 4 million, isn't it? Is that the case?
Yes.
Okay. The cost that we are going to incur in year 1 to what? Finish the contract is 4 million. And we have incurred 1.8 already. We are expecting to incur what? 2.2. So the total cost in year 1 will be 4 million against the revenue of what? 5 million. So the total profit that we'll be getting from the contract is what? 1 million, isn't it? Okay. What is the percentage of the work done? What is the percentage of the work completed?
45%.
So it means that you have to recognize only 45% of the profit for this year. And that will give you what?
450,000.
450,000. So this is another way of calculating the what? The profit. But the question says you show revenue. So we have to calculate the revenue We have to calculate the cost of sales, find the difference, you get your profits. All right. Let me say this before I move on to the liability and then the contract assets. Okay. This is for only 2008. We are going to look at the contract asset or contract liability for 2008. Let's come here. Let's come here. You see, the company might start the contract, but they are not sure that they are going to complete the contract. So if you start a contract, you are not sure of completing the contract. The only amount, the only revenue that you can recognize is the cost that you have incurred on the contract up to date. Because you don't know that you're going to complete the contract, you don't have to recognize what? Any revenue. So the only amount that the people are going to pay you is the cost that you have incurred on what? On the contract. But if the company is sure of completing the contract, then they can recognize revenue when performance obligation is satisfied over time. Okay, let's come here. What is the cost that we have incurred up to date? What is the cost that we have incurred up to date?
For 2008 is 1.8 million.
Okay, so if we want to collect or if you want to bill our customers now, if we want to bill them, all things being equal, how much are we going to be expecting from them to pay? We are going to be expecting the cost which is 1.8 in addition to the profit that we'll be making, isn't it? So this is how we are going to bill them. We are going to say that we have completed what? Part of the work. So you have to give us the cost plus the profit on it. That is how we are going to bill you. Okay, so what will be the total bill here?
$2.25.
That will be 225, isn't it?
Yes.
So, okay. But how much did they pay? How much did they receive?
1.5.
So the cash that we receive from the people is what? 1.5. How much is remaining?
The difference.
750.
The difference is 750. So the 750 is what we call the contract assets. The 750 is what we call the contract assets. So if we want to build you, we have to pay the cost in addition to the profit that we are charging you. We have completed this part of the work. So this is the cost, this is the profit. So this is the amount that you are going to pay us. But you have paid us only 1.5. So the remaining amount that you are owing is what we call the contract asset. That's what we call the contract what? Assets. That's what we call the contract asset. Let's count to 2x9. The 2x9, they are asking us to show what? The profit or loss and those ones for the 2 years, isn't it? Okay. 2x9. Can we calculate the contract value will still be the same, isn't it?
Yes.
Okay. The cost to date is what?
Cost to date is 3.6.
Okay, 3.6 million. What is the cost to complete?
900,000.
Cost to complete is what? 900,000. So what is the total cost of completing the work now? What is the total cost of the work in 2009?
4.5 million.
4.5 million. Okay, let's find our percentage. This will now be, that will be 80, isn't it?
Yep.
Okay, so that will be 3.6, 360 over 450 times 100. That is 80%, isn't it? Okay.
Yes, sir.
So let's now come here. Let's calculate our portion of the revenue for 2019. What will be the revenue? It will be 0.8 times what? 5 million, isn't it?
Yeah.
So how much are we getting?
4 million.
It's 4 million.
Yes.
Okay, but we have already recognized what?
2.2 million, 2.25.
So what will be the difference?
1.750.
Okay, so this 4 million revenue is for the 2 years. It's for the 2 years. It's for 2 years, but we have already recognized what? 2.25. So the difference between them will be the revenue for this year, which will give us how much?
175,000.
So 17500. So this will be the revenue for this year. Although the revenue is 4 million, but out of this 4 million, we have recognized what? 2.25 already. So the difference will be the revenue. Let's count to cost of sales. The cost of sales will be the 3.6, isn't it? The cost of sales will be the 3.6. But out of that, we have already recognized what?
1.8.
Okay. So we have already recognized 1.8. And that will give us how much? So it is 3.6, but we have already recognized what? 1.8. It means that the difference will be what? 1.8. Are we correct with that one?
Yes.
So what are we having now?
A loss.
A loss of how much?
0.05.
Which is 50,000.
50,000. Yeah.
Okay. Let's now come to how we go. We can also decide to find this loss straightforward. How do we find the loss? How do we find the loss? Okay. How do we find the loss? All right, let's come. Let's come to this. What will be the, in year 2, what will be the profit? In year 2, what will be the profit on the contract? In year 2, what will be the total profit on the contract? Would that be the 500,000 minus 450?
Yeah.
Okay. And the profit will be 500, isn't it? And we are going to find only what?
80%.
Okay. How much are you getting?
400,000.
400,000. But what was the profit that we recognized first?
450,000.
The profit that we recognize is what?
450.
450. The first year is 450. But the actual profit for the first year, the 2 years now is what? 400,000. It means that you have over recognized your profit by 50,000, which is the loss. Are you okay? Okay. So the loss over there, this is a loss. This loss over here, you show it as what? This loss will go. So let's now calculate our contract asset for this particular year. So the contract asset will now be the contract asset for this year we'll look at the cost to date. The cost to date is what?
3.6.
3.6. Okay, out of this 3.6, we have a loss, isn't it? Not profit. So that will be 50,000.
Yeah.
So what will be the difference?
$355.
355. Okay, so how much did you receive from the people?
2.4.
2.4, isn't it?
Yeah.
Okay. So what will be the difference?
1.15.
Okay. But what was the contract asset recognized first? 750.
Yeah, 750.
So you just subtract that one from the 750. This is the contract asset for the 2 years. So you take the first one from it and you have the contract asset for the second year. All right. Very interesting and simple. All right. Let's look at borrowing costs. What is the borrowing cost? What is the borrowing cost? Borrowing cost. Okay, borrowing cost. Let's take the question 1 and 2 and see whether we can finish within 12 minutes. Auntie, Emmanuel, or the this thing is the revenue has confused you.
That's really confusing, but let's go.
It is well.
Question,
Pass the exam.
question,
Pass the exam. I come and learn.
sure. One is Matata Company Limited is a company that deals in international trade.
No, senior. The way you started, you should complete like that. Your voice is too down. Why? It's 100 marks, and they're asking to get 50. So what is the problem?
But so getting a 50 alone is not even easy.
Let's move on.
So Matata Company is a company that deals in international trade a lot, and as a result has employed additional managers who are skilled in international business. The company found the need to put up additional building to accommodate the newly employed managers. The building, which cost $800,000, was financed through a special loan. A special loan the company contracted on 1st January 2013 from Adom Financial Institution, 15% 300,000 loan. The additional money was financed from the company's pool of funds, which consists of 18% 400,000 loan and then 20% 500,000 loan. The disbursement from the pool of funds was made on 1st January 2014. The construction of the building started on 1st March 2013 and was completed on 30th November 2014. However, the construction in the month of August 2013 came to halt, but this was identified as administrative in nature. The accounting year ended end of the company is every 31st December. Required. Calculate the borrowing cost capitalized for the assets and the expected cost of the assets as at 31st December 2014.
Okay. So we are saying that any asset that is going to take time for it to be ready for use, any money that you have taken to finance that particular asset, you know that if you have taken a loan from a bank, ideally the interest that you are going to be paying will be sent to profit or loss. But here is the case: you are taking the money to finance the construction of an asset. So if you are taking the money to finance the construction of the assets, it means that without that particular decision, you are not going to take the loan in the first place. So the interest that you are going to pay over the time that the asset is still under construction, that portion of the interest should be added to the cost of the assets. That's what the borrowing cost is saying. All right. So the borrowing cost, we have so many things there, but that is not why we are here. Let's solve this question. Okay. You can see that the building which cost 800 was financed through what? A special loan the company contracted on 1st January 2017 from Adum Financial Institution. 50% were 300,000 loan. The additional money was financed from the company pool of funds, which consists of what? 18% loan and 20% what? Loan. The disbursement from the pool of funds was made on 1st January 2014. The construction of the building started on 1st March 2013 and was completed on what? 30th November 2014. However, the construction in the month of August 2013 came to halt, but this was identified as administrative in nature. So what they are saying is that you can see that the question itself. Okay. That is nice. Okay. I've gotten it now. I was having problem with the dates. Okay. What we do now is that, you see, sometimes the construction, there can be an issue with the construction. They can start with the construction, then the workers will declare that strike. They have one that they will come to work all right, but they will not work. They will not work. So they will say that they are not going to work again, and these people have to pay them. This is not relating to what? Improving the condition of the building. So if a situation like that happen, the months that or the number of months that this is going to take, borrowing cost should not be capitalized. It should cease. Borrowing cost should be ceased. But if the thing that is causing the construction not to continue is administrative related, maybe they want to they want to raise the area. They want to raise it to the situation where the building can be something. These are relating to work that will make the building, or these are relating to things that will make the work easier. So if he has to do with maybe issue with maybe those people produce permits, stop work, produce permit or something like that. These are something that is not for administrative purpose. This is something that is not to improve upon the condition of the building. So this one too, borrowing cost must be ceased. Shortage of labor, shortage of raw materials, borrowing cost must be ceased. But any work that is carried out to make sure that the work is being done effectively, or that is going to improve upon the construction of those things, borrowing cost should still be capitalized. So let's now look at this question. The loan, we have a specific loan and loan from pool of funds. So we have a specific loan and also general loans or general borrowings. Okay. The specific loan was constructed on which was contracted. When did we take the loan?
1st January 2013.
2013, isn't it? Okay. The construction of the asset started on which date? The construction of the asset started on which date?
1st March 2013.
So it means that for the first 2 months that we have taken the loan, we haven't used it on the on the asset, isn't it? The first 2 months, the money was not used on the asset. So the interest relating to the first 2 months, which is January and February, must be expense. So let's count the borrowing cost in 2013. The borrowing cost in 2013 will be what? The borrowing cost that will be capitalized. Borrowing cost to be capitalized will be what? 10 months. That will be from 1st March to 31 December. That will be 10 months. So this will be, what is the interest rate for the specific borrowing?
15%.
For the specific borrowing, whether you use all the money or not, the interest will be the full interest. Whether you can decide to use 1 cedi of the money, but you still charge the full interest. But some companies, they can take the loan, but they will not use it. In that case, no amount relating to that particular loan, or the interest relating to, or no amount of the interest relating to that loan should be capitalized, because you haven't used any of that amount on the on the construction. So the company can take the loan and they will be using the loan for different things. The portion of the interest relating to that loan, no portion of it will be capitalized as part of the cost of the asset, because they haven't used any portion of the loan on the assets. But if you have 1 billion and you decide to use only 1 cedi on the loan, if it is a specific borrowing, we are going to charge the full interest and add it to the cost of the assets, because you have taken that loan specifically to finance the assets. So this will be for only 10 months. That will be from March to December. Although the question is asking us to show the borrowing cost for 2014, but they are asking us to show the cost of the assets. So the cost of the assets will be the borrowing cost for the first 2 years will be added to the cost of the assets. All right. So let's count the borrowing cost. That will be 10/12 times what? 15% times 300,000. Would that be 300,000?
Yes, sir.
Okay. So what will be the 300? You can see that the month of August, since it's administrative related, we still capitalize the borrowing cost. So that will not be subtracted. That will give us how much?
$37,500.
$37,500. So you can see that the general borrowing, none of the general borrowing was used in 2013, isn't it? We started using it from January. So let's count to Let's come to specific borrowing again, 2014. The asset was completed on which date? Completion was done on which date?
30th November 2014.
So that means the construction was done for 11 months again, isn't it?
Yes.
So the borrowing cost to be capitalized will be 11/12 times 0.15 times 300,000. That will be how much for 2014? Eh,
41,250.
you buy any phone? Oh, this one. Oh, you carry it out. Uh-huh. Wait, plug this machine in. Is it a battery good? Or are they use more than 3 hours? Are they use the battery more than 3 hours? It is what?
41,250.
41,250.
250, yeah.
Okay, that is nice. So 41,250. So they are saying that the remaining loan was financed through what? The general borrowing, isn't it? Okay. So what will be the remaining amounts that will be financed through the general borrowing? The remaining amount will be what? The 800,000 minus 300,000. Is that correct?
Yes.
And that will give us 500,000. Okay. So this will now be what? You can see that we have two different loans, isn't it? With two different rates. What is the rate that we are going to use for this one now? So what we do now is that we find the interest on each of the loan. So let's take the loan one by one. Let's assume that the loan A. What will be the interest on the loan A?
75,000.
It will be 0.18 times what? 400,000.
Yeah.
And that will give us
72,000.
72,000. Okay, let's come to loan B. What will be the interest on that? 0.2 times 500,000.
100,000.
100,000.
Okay. So what is the total interest now? What is the total interest that we are paying on the other loan?
172,000.
Okay. So you can see that this interest was paid on the two loans, isn't it?
Yes, sir.
So what is the value of the two loans? What is the total value of the loan?
900,000.
So the total value of the loan is 900,000. Okay, the question now is what rate, if you apply it on the 900,000, you will get 172,000. What rate, if you apply it on the 900,000, you will get 172,000. That rate, we call it the WACC, which is calculated as the total interest over the total value times 100. Okay, those who are doing FM, they can also calculate this one separately, where they will have the interest over the total value. Like we have the WACC, VE over VD plus VE times the cost of capital, cost of equity plus that one. You can also do that one and get the same answer. But the idea of that particular thing is that if we are paying interest of 172 on a total value of 900,000, what rate, if we apply it on 900,000, we'll be getting 172,000. That rate will be calculated like this. It will be X over 100 times the 900,000. That will give you 172,000. Okay, so you are going to be having something like this. You are going to be having X times 900,000 is equal to 172,000 times 100. So we divide both sides by 900,000. We divide both sides by 900,000. And which can be, S can also be expressed as 172,000 over 900,000 times 100. That's how we got this particular formula. All right. So let's come to, what is the WACC?
19.11.
19.1. Okay. So this is the WACC that we are going to apply on the loan that was used to the part of the loans that was used to finance the project. So the borrowing cost relating to that particular portion will be 11/12 times 0.191 times the 500,000. Am I correct? Okay.
Yes.
So what are we getting?
$875.87.5.
Let's to the nearest Ghana city.
875.88.
588. Hey, I'm getting 542. Can someone confirm that?
Okay.
So
Confirm.
Okay. So let's look at the total borrowing cost for this year. For 2014, the total borrowing cost will be what? Will be the 87542 plus the specific borrowing cost, which will be 4125. 4125. That will be the total borrowing cost. The cost of the assets will be the 800,000, which was the amount spent on the assets, plus the borrowing cost for 2013, which was 37,500, plus the borrowing cost for this year, which will be the addition of these two. So you can add these two, then we add it to this one. All right. The question two, what I will do is that I will, someone should read it. Let me see whether I can solve that one within 5 minutes or 4 minutes.
Question 2. It is on 1st January 2011, Sherry Company Limited entered into 11 million contract for construction of an office complex in Kumasi. The building was completed at the end of December 2011. During the period, the following payments were made to the contractor. Sherry's borrowing as at its year end of 31st December 2011 were as follows: 10% 4-year loan note with simple interest payable annually, which relates specifically to the building's project. Debts outstanding at 31st December 2011 amounted to 3.5 million. Interest of 350,000 was incurred on this borrowing during the year. An interest income of 100,000 was earned on these funds while they were held in anticipation of payment. 12.5% 5-year loan note with simple interest payable annually. Debt outstanding at 1st January 2011 amounted to 5 million and remained unchanged during the year. 10% 5-year loan note with simple interest payable annually. Debt outstanding at 1st January 2011 amounted to 7.5 million and remained unchanged during the year. Required, calculate the borrowing cost to be capitalized. Interest expenses are the only borrowing cost.
Okay, sometimes they can give you see the debt figure. Sometimes they can give you two figures. They can give you one at a reporting and one at what? One at the start. So what you do is that you use the reporting figures. Okay. All right. Let's come to this one. This one, they are not changing. Nothing is changing. So they are still the same figures. All right. You can see that they have given you the schedule about how the payment was done. So you can see that on 1st January, they have made what? 1 million payments, isn't it? 31st March, they have done 3 million. Okay. They are saying that the completion of the asset was what? They started on 1st January and they have completed on 31st December. That is a full year. They are saying that a 10% 4-year loan note with simple interest payable annually, which relates specifically to the building, debt outstanding at what? 31 December 2011 amounted to 3.5 million. Interest of what? 350,000 was incurred on this borrowing during the year, and interest income of 100,000 was earned on these funds, what they are held in anticipation of payments. So sometimes what the company will do is that they have gone for the loan, but they will not be using all of them at once. They will not be using all of them at once. So what they do is they will put the one that they want to use, they will use it, they will put it into the construction, then they will go and put the one that they are not using now into a bank to generate some income. Whenever they need it, then they will go for it. So the income that they are going to generate over there is from the money that they have borrowed. So if you want to know your net borrowing cost, you look at your borrowing cost relating to that particular loan, then you subtract any income that you generate from investing the remaining amount of that loan. That is it. But that is not the factor. What is the loan outstanding at the end of the year for the specific loan? What is the loan outstanding? What is the balance outstanding?
500,000.
What is the interest on that particular loan?
350,000.
That is telling you that the loan has been taken at what date? The loan has been taken on which date? The interest is 10%. The amount outstanding at the end of the year is 3.5 million. The interest is 350,000. This is telling you that the loan has been taken on which date?
The completion date.
The January.
Yes, the loan has been taken at the beginning of the year. So the first payment that was made on January was from the specific loan. So they have what? They have 3.5 million at the beginning of the year. They have made 1 million payment to what? To the contractor. So let's look at the borrowing cost for the specific borrowing. So the borrowing cost for the specific borrowing will be the interest rate, the interest minus what? The income. So the specific borrowing will be what? 250,000. Am I correct? Okay. The specific borrowing will be the interest minus any income that you generate from investing the excess funds on the specific borrowing. But let's come to how we are going to calculate the borrowing cost for the general borrowing. Borrowing cost for the general borrowing. So the specific borrowing, whether you use all the funds or not, the interest will still be calculated as full. The only thing that you are going to do is when the construction has not started at the beginning of the year. That is the only time that you prorata the borrowing cost. So the first one that we have done over here, it means that 2 months of the interest have to go to what? Profit or loss. But the question is not about that one. Okay. So it means that the first payment of 1 million was made from which fund? The first payment of 1 million was made from which fund?
350,000.
Okay.
Specific borrowing.
Okay, so what will be the balance on the specific borrowing after the first payment has been made?
2.5.
2.5. Okay, 31st March, what was the payment made?
3 million.
So it means that they have taken how much from the general borrowing?
50.
So it means that from 1st April to December, they have taken 500,000 from what?
The general borrowing.
The general borrowing, okay. So you can see that all the subsequent payments are being made from the general borrowing, isn't it?
Yeah.
So 30th September, that will be from 1st October to December, isn't it? Okay. So October to December, they have taken what? 6 million. Is that the case?
Yes.
Okay. But on the last day, which is 31 December, that will not attract any interest because the money has been there for any month. It hasn't been used for any month. That is at the end of the year. So the question now is, what figure are we going to use? What will be the rate that we are going to use to calculate the borrowing cost for the general borrowing? Then you come to the general borrowing figures here. We have 12%. 12%. Okay, my board is I can't go forward again. So let's calculate the 12%. Loan A. Loan A will be 0.125 times 5 million. Is that correct?
Mhm.
Okay. How much are we getting? I'm getting
625. Yeah.
6,000. Okay. Let's come to the loan B or the loan 2. That will give us what is the rate? It will be 0.1 times what? 7.5 million. That will give us 750,000. Is that correct?
Yeah.
Okay. So what is the total interest? I'm getting 1,375,000 divided by 12 million. So it will be the total interest divided by the total loan. So 1,375,000 divided by 12,500,000, all multiplied by 100. I'm getting 11%. Okay. So this will be multiplied by 1.11. But from April to December, how many months is that? From April to December, how many months is that?
9 months.
So this particular money will be used for 9 months. So this will also be 0.11 times October to December, October, November, December. That will be 3 months. So what will be the borrowing cost for the April to December? How much are we getting? I'm getting 41250. So we have 0.11 times 6 million times 3 over 12. I'm getting 165,000 over here. So my total borrowing cost will be the specific one, 250,000 plus 41,250 plus 165,000. All right, that is it. Seniors. All right. You can try the rest of the questions on your own. Yes, please.
I think the question also said the interest income are supposed to expense.
They said interest expenses are the only borrowing cost. That's what.
Okay, sorry.
Okay.
Linus,
Yes, please.
so I have a question for you. I think that one is on
Manage it.
No, ethical.
You say you have a question. I have missed is my property. Have shows possession. So
Okay, please let me. I don't know. You tell me.
so any
So
special you can try the questions on any special there and the other standards there. All right. Okay, you can ask your question.
Please, can I read? Can I read?
Or if you read, I don't have retentive memory, so maybe before you finish the first line, maybe I have forgotten the other line. So maybe you send it to me.
Okay.
Yeah. Okay. So Charlie.
But what if it's going to benefit all of us? You should ask the question so that we can also benefit from it.
But she's going to read, and this is the case. I don't have retentive memory.
We'll remind you of it.
So before she will finish the first line.
I'm just going to ask one question.
Okay.
When you are asked to discuss the ethical issues,
it is the same as the principles.
It's the same as the principles.
So just list the principles and explain why you are saying, based on the case, why you are saying that particular principle is an issue there. Or you can decide to talk about the issues one by one. So you can see that if in the case you can see that the boss is threatening the employee that if he or she doesn't do this and this, he will be fired. So you can point on that particular thing and say that because of that particular threat, this person might not be able to do the right thing. That is an ethical issue there. Or you can also talk about objectivity. Then after saying the objectivity, then you can say that there is an issue of objectivity, or objectivity says that you should not be biased, you should be professional, you should not allow any undue influence override your professional judgment or those kind of things. But given the situation where the person is being threatened, it means that the person is going to what? Allow overdue influence, which is a threat, to interfere in his work. So you can either say it the way it is, or you can classify it under a principle and talk about it.
Linus, please, please. So maybe can you also use the threats? So maybe.
Yeah, you can use the threat depending on how you are able to explain it.
Okay.
So if you are saying that the threat, that they say you should discuss the ethical issues. So if you will say that the threat is going to bring an ethical issue, then you explain how the threat is bringing an ethical issue. That is all.
Okay.
But don't go there and be explaining the threat. No, they are not asking you to explain. They say you should discuss the ethical issue. So why are you saying that this particular threat is bringing an ethical issue? Or what ethical issue would the threat be bringing? That's what you are going to talk about. All right, thank you. All right. So in the absence of no question, which I know that there is no other question, we are calling it okay, where I'm talking from is actually a day. So we are calling it a day, and you people should call it a night. I wish you all the best, and my name is Dela Venunya. All right, I will see you guys.
Thank you. God bless you.
All right.
Thank you so much.
All right.
We'll get you a DB.
Very necessary.